All right, we are here. We've got the campfire on. It's been a hot minute. We're in a new camp, aren't we? A new camp setting.
Yep.
We're in the new
Good coffee,
studio. Yeah,
but no marshmallows.
No, but that's a Rwandan single origin.
Rwandan. It's a great coffee. It's the best of the three I've had today.
Yeah, it's good. Roasted just around the corner, Josie Coffee Roasters. So
Shout out to Josie.
Shout out.
And her coffee roasters.
Well, yeah, a bit of a story there, but hey,
Is she your new best friend?
well, I've spent a bit of money there. Okay, Jimbo, do you want to just explain who you are?
Yeah. I'm James Millard of Sufficient Funds. That's our business. We have mortgage broking and financial advice.
Right.
Mainly working with people somewhere between about 25 and 50.
Sweet.
Yeah.
And who are you?
I'm Vince Scully. I'm founder of Life Sherpa, Australia's largest online financial advice house, and the licensor of this podcast.
You really
So
are.
I am the one who goes to jail when Glenn says stupid things.
Don't mess up.
So on that general advice only, there's a link in the show notes to all our disclaimers and all that stuff.
Fees, terms and conditions apply. Read the PDS.
Exactly. All right. So if you are new to this podcast, we do kind of a long form thing every now and again where, we just take our time. We don't need to stress about making things. We're just talking basically. And
This is a deadline-free zone.
this is a deadline-free zone, but we can get into the weeds of stuff. We can get a bit more technical. We're not going to stop and say an ETF stands for whatever it stands for. I don't even know what an ETF stands for. Okay, so we just kind of assume any acronyms that if you don't know, you will know at some point in your financial journey. This is all on YouTube. It's the first time that three of us have been in the new studio. So, we're just sitting around chatting.
We're playing
We are.
around the campfire.
Exactly. So, Jimbo, do you want to see if there's a question there that
Yeah.
you can start with, and then I'll bring up the old question list myself.
I mean, there's a good one here from Ebony that probably allows us to really ease into this today. Would love to hear about your career experience and what your genuine thoughts were or are on being an advisor or a finance career in general.
Well, what are your thoughts on that?
I mean, I love it, right? I've been, my experience, I've been in this world for getting close to 2 decades, which is
Really?
a little scary.
2? You're just a boy.
Just a boy with a few greys under this. It's not an
this
Akubra. It should be.
It's a
We're
sufficient
camping.
cap.
Sufficient. Going beyond today.
Okay, so you're being 20 years-ish.
Yeah, 15-ish.
And what do you like about finance?
Look, I mean, for us, financial advice it's about that. It's actually about the people. It's about really connecting with people, understanding all the fun things they're working on and all the cool things they want to do with their life. And for us, we're just plugging in a money plan. So anyone who works at Sufficient Funds, they've got EQ, they've got the ability to talk to people, really dive into their lives. And then, yes, we're the money nerds. We can still bring it together and put it all in place. But it's how do you make that connection between money and life? So experience-wise, started off in a big kind of straight out of uni in a massive corporate, rolled into a much smaller business that was then a national business very quickly and grew fairly quickly through that. I was lucky to be early in the employee list, and so I flew through in terms of I was always in the deep end, and all of a sudden I was managing a big team. And then when it came to starting our own business, I guess it was back to clients, back to the core, the foundation of why, and I guess my chance to really lean back into why do we love this stuff, and so chance to build a business around what we do and what we really enjoy about it. And yes, it's the money, but it's also the people, and I guess that's where financial advice, Ebony, if you're thinking,
You mean yes, it's the money. It's a good paying career.
what do you mean? Yes, it's the money. We're working with money.
Yeah.
And there's an interest in it. Obviously, you have to have that.
Yeah.
And the finances and the numbers, but there's a connection between people where financial advice is, if Ebony, you're listening to this and you're thinking, oh, well, that's why I'd lean that way or not, then there you go. I think finance careers in general can be very, very different to the financial advice is one small option.
Yeah.
I mean, it is one of those few careers where you can actually go home at night and realise that you've made a genuine difference to someone's life. And for me, it was the thing that I started at the institutional end of the market, where you got your bonus because you made more than anyone else or lost less than anyone else, and there was no human at the end of the money.
Mm.
But when you move into the retail world, where you're dealing with real people with real lives and real money, you can actually go home at night and go, I've made a difference to someone's life today.
Mm.
And that's something people, I guess, associate with the caring professions like doctors and medical and all those sort of things. But this is a part of the financial services sector where you can actually have a genuine difference to an individual's life.
Yeah, absolutely. And yeah, Glenn?
Yeah, well, I don't know. I just think for me, it just came out of my own personal interest in personal finance and be like, oh, it'd be cool to be a financial advisor. But the more I learned about financial advice, the more I understood that it was less about knowing as much as you can about money and like the legislation, tax, super, estate planning, that becomes hygiene. And then you're basically a project manager between an individual person or a couple and their goals. Whether it is a business and I'm doing business insurance or business succession, buy, sell stuff, it's literally the book smart stuff becomes hygiene.
It's about the relationship, right? And in that relationship, there's so much complexity. You've got to understand the human at the other end. You've got to set expectations at the right level. You've got to make sure you then meet those expectations. I think one of the challenges, an early CEO that I worked with he's like, you imagine yourselves as advisors and the relationship and the extent to which you need to keep delivering to make that work. Compare it to a used car salesman. They've got one chance, they get it right, they sell it, you're done, you're out the door. As long as you get that one bit right, you're done.
Yeah.
The easy part is giving advice. The harder part is ensuring people act on it. So there's not much point being a doctor and writing a script knowing that they're not going to fill it. You've actually got to be able to align the technical stuff, the spreadsheet, with the psychology of the human. And that's the real science in this.
So what was the crux of the question? It was like, why did you guys do...
Does Ebony want to be an advisor?
And do you want to just put mute on your Surface as well?
Yeah, I just did. So, yeah, would love to hear about your career experience and what genuine thoughts you have on being an advisor or finance career in general. So, yeah.
Yeah, I think a finance career, if you talk like sector, you've got it's such a big industry. It's almost like you can be in building and construction and be in marketing or a HR, or there's all these sub roles in these industries.
Yeah, and they have different cultures. Like when I was at Macquarie, the difference between the structured finance guys where I was and the corporate finance guys who were doing M&A, they were like a different universe.
Yeah,
they behaved entirely differently, completely different culture, and it's like you're in two different industries, and that's just sitting the guy at the next desk almost.
Yeah.
And I think you'll find a lot of careers in finance are not people related.
Yes.
Right? They're just numbers on a screen, and maybe that's what makes you tick. If so, you're probably heading in that direction, Ebony. But if it's a people thing, well, then that's where this interaction needs to be part of what you're looking at. And so financial advice, the entry into this world is now more challenging than it ever has been. And you require a degree, and then you need to go through a professional year. And that can be all done on the job, of course, and very important that you do that because that's the critical part of starting to learn. The professional year is often a little bit longer than 12 months because there's so much to get your head around.
Yeah.
But generally the entry level into financial advice is you work in and around understanding the basics of client services. How do we help complete applications? What goes on behind the scenes? Maybe getting some experience around how are these plans actually built? looking at the systems and working
Yeah, I
that
actually
out?
think it's probably more of a question to start with. Do you, in your career, want to be client facing? Like, it's a yes or no. And if it's like, no, I don't love helping people direct, well, okay, so we go into maybe paraplan or some type of associate role or
Yeah.
a para broker or a para,
And I think the
whatever they
type
say.
of person you want to be in front of.
Yeah.
So there's a world of difference between talking to a young high earning accumulator and a retiree on the retail side, or a professional fund manager on the other side.
Yeah.
That's a completely different interaction. And the real human bit is the more satisfying bit, to my mind.
Yeah.
And then mortgage broking at a similar level, different barriers to entry, but still a people person.
Yeah.
People.
Bit more
people type role,
transactional.
right? Bit more transactional.
That will probably be less as time goes on, though, because, people are, the banks are putting more money into broking as a distribution. So I think if you are a mortgage broker or get into it, it can be long-term relationship.
But there are big gaps between the touch points.
Yeah.
Bigger probably, yeah.
People don't buy houses every year.
No. So there's actually just a question here, and it came in today, and we are actually recording this if we stamp it on the 14th of February. Happy Valentine's Day, ladies.
Oh,
Galentine's Day.
hello.
So James just put in the Facebook group, now the podcast studio is up and running and you're making videos for YouTube. Is there any chance to get the videos embedded into the podcast episode? My wife sends me this podcast. Turns out it was on money too, but it also has its video embedded in the podcast. Food for thought, photo in the comments. I'm just having a look at the photo in the comments. What's this podcast? Making Money Matters. Yeah, so the short answer is it's complicated with distribution at the moment for podcasts. It's hard. I might actually, I'll reply to James in the Facebook group for the actual thing. I don't want to get into it, but effectively you have to at the moment host your podcast on Spotify's platform and you upload the video and that platform will send the audio to Apple and other feeds and also the video on Spotify. At the moment, our host Acast doesn't have the technology for me to insert a video and propagate it. And I don't think Spotify allow you to do external video propagation. Apple are toying with it. It's on their agenda. And the same thing, we can't put our podcasts yet onto YouTube because if you embed, you can send an RSS audio file to YouTube automatically, but YouTube blocks it from Acast at the moment and other providers because the thing with YouTube is they want to serve the ads and they know if I send my RSS feed to YouTube, there's an ad embedded. So,
but you can just upload the MP4 file separately.
I can, but that a couple of things like it just adds another layer of human resources that you need and all that stuff. So yeah, I would like to, and we're still not doing every podcast video. So there's that as well. And our podcasts are pretty edited. And it would just change a few things, how we do it from a production line. We actually are starting a new show maybe end of March. And what we're doing from day one, it is going to be a YouTube show.
There's a lot of
and we're not calling it a podcast. It's a YouTube show, less than 20-minute episodes, shot here in the studio. So in our back end, we will, because it's a lot of it is because we've got such a machine with our content. It's easy for me to start a new show, video only, or video as the primary thing, and then we rip the audio out once it's edited and send it to podcast. So it's a big thing, and before we hit go, I spent freaking 40 minutes dicking around. We've got 4 cameras in here, and we'll put this whole episode on YouTube, but it's just another layer because I don't have a producer in the room. I've got an auto switcher. I set up the cameras, even looking at me now on the screen, you'll see that potentially if I just sit up like this, I'm a little bit smaller than Vince and Jimbo. Some people would notice it. The reason why is I need to have enough frame around me for my team to cut in, and it just gets complicated really fast.
But I think a lot of people, actually, I do watch a lot of podcasts, or listen to a lot of podcasts on YouTube. And if you've got premium YouTube, it will play in the background.
Yeah.
So a lot of people don't actually watch the video that's attached to the video podcast.
Yeah. Yeah. So,
And it sort of doesn't fit with the podcast vibe, where a lot of people do podcasts whilst doing something else, like driving.
I mean, I don't mind having a video podcast on, so at least while they're talking, and I've got the tech here now, like I can screen share, and so I think I'm actually even thinking the other day, I'll do another update on the This Is Business podcast, the changes I'm going to be making in the business, but everything I do going forward, it's going to be radically different because we're in a different world now. When we started this podcast, we're the first Aussie personal finance podcast by Aussies for Aussies, and it's a different world now. And, we started it, right place, right time, right thing, literally printed money. The revenue's coming off because there's more podcasts, more ad spots to sell. The radio business is moving into podcasts. They've got more inventory for ad revenue. So the money is just, it's going. So I now, for the first time in, this is our 8th year, have to actually put effort in. And, people
might be back to 5 days a week. Hey?
Yeah, I know. I think, gosh, I'm going to have to actually work, which is weird because, it's all good, but the world has changed. Let's go to another question here. Let's have a look here. Let's actually, while we just have a look here, I'll get Sean to drop in our pre-roll ad marker right now. We'll be back right after this. Okay, let's get started with something a bit light and easy and fun and the vibe and all that. Shirley asks, how do you prioritize travel/life experiences versus saving/investing? Jimbo, I'll go to you on that. This is probably really up your dirty alley or whatever the word is. Talk to it, because you wrote the book Insufficient Funds. This is your shtick. And if it feels like we're a bit awkward and weird, it's because I think we are getting used to being in a studio, face-to-face, video rolling.
We're awkward weirdos.
And we're awkward weirdos.
Let's own it.
We're not having headphones anymore, so it feels weird. I'm stressing because I'm like, I hope this is recording, but I think it is.
You did press record, didn't you?
Press record, yep. So, Jimbo, talk to us about this question and the prioritization, and maybe how you would address this with a new client that comes in. And maybe I'm just going to feed you a heap of stuff and I'll shut up and have a coffee. Talk to us about your type of ideal client in your business.
Okay.
So go for it.
So thanks, Glenn. So I guess Shirley's question, how do you prioritize travel and life experiences versus saving and investing? It's a big one. So really, I mean, it starts with getting super clear on what matters. And if travel is one of those other experiences, it's about actually being super really clear on, well, what does that actually mean? Because when you get really clear on the things you want to achieve, then the money plan becomes a lot more obvious. And so for us and how our client process works, we have an initial 15-minute call. We call it a launch call. If someone is a really good fit and they're vibing with us, and then we dive into this session we call Defining Sufficient. And that's a paid session where we explore all of that. What's coming up for you in the next year, maybe the next 5 years, beyond that if you're looking that far ahead, and really start to push and prompt. And so if someone says, look, we want to travel, then our kind of go-to is, well, where? And then it goes to why. And so starting to unpack some of that for yourself is saying, well, why do I really want to do this? What's that? Is it just a break from work? Am I stressed out of my brain? Is it actually a career problem? When you start to explore some of this a bit further, you can go in all sorts of different directions. But ultimately, you're coming back to, well, these are the things that matter. And then you have to then build your spending plan. When you get paid, where does it go? Around those priorities. And so if it's experiences, so we caught up with a client yesterday and she's like, hey, health is my new priority. I've factored in a PT. I'm paying $200 a week for it. I know it's a big cost, James, but it's worth it, right? I'm feeling better for it. And so all of a sudden that conversation has opened up a life's getting better. I'm healthier. I'm happier. And yes, it costs, but if you can balance that, then it works. And so for travel, we generally would have, the clients would have their money comes into a certain account. We call it a bills account. It's funneled into different directions, but you're saving intentionally for what's coming next. And so that might be a big Europe trip. That same client's taking the family, they're in their early 50s actually, and they're sitting on a bunch of cash, and they're one of those clients that we often see their situation's way better than they think it is. And sitting on a whole lot of cash, they're earning heaps of money, they're well on track for retirement, and they could be living a much bigger life right now, and they really desperately want to.
So I think, and chime in, Vince. So basically, first, you're saying your clients are sitting on a big cache of money. You're obviously taking premium end clients.
So,
because I would like to be sitting on a big cache of money.
I mean, it's a bit of a mix. Our clients, where we add the most value is you've got options.
Yeah.
Right? So you're saving. It starts with a capacity to save something, and generally, I would say if you're in the game of being able to save $1,500, $2,000 a month or more, then you've got decisions to make. It's like, are we stashing that in the bank? Do we pay off debt? Are we investing? Are we saving? And coming back to Shirley's kind of point around that is the savings versus investing part. We call it the stacks, right? So it's 4 stacks. Are you paying off debt? Are you saving? Does it stay in the bank?
Yeah. So I'm just thinking, because if someone wants to reach out to you directly, maybe if you don't have a household income of less than 200 or 120 as a single, because that's kind of when I refer people to sufficient funds, it's kind of, you need a bit of meat to work with them to the value that you bring.
It might have been that they've bought a property already, so there's a little bit of equity, there's something to play with there, or they've got maybe 50 grand or more in the bank, often it's an inheritance or something else that's been happening.
Yeah, okay.
And decent income so they can save a bit.
But before you go, Vince, I think the question here, how do we prioritize travel/life experiences versus saving and investing? I think it's got to be that thing that you want to prioritize. Is it an always on thing, or is it we've got this goal to do Europe for a year in 3 years' time, and that's 80 grand or 60 grand? Then we move on and get back to business as usual with our life.
Yeah, but I mean, the thing that sticks out in that question to me is that it's expressed as a money question, whereas it's actually a life question, because saving and investing is just tomorrow's spending. So what we're asking here is, how do I prioritize how much I spend today and how much I spend tomorrow or next year or next decade or next century? And that's a life decision. That's not a money question. And sometimes the traditional financial literacy school of money advice, where the starting point is needs or wants, is the thing that leads into this sort of scarcity mindset. That if you've done any psychology at uni or work, you've heard of Maslow's hierarchy of needs. It's not called Maslow's hierarchy of needs and wants. They're all needs. They just have different expressions. Some of them are, about staying alive, like food, shelter, warmth, security. But ultimately, most of us living in a Western developed economy, we have enough.
No, but
sorry, no, go on.
Oh yeah, I was going to say, because that Maslow's hierarchy of needs in the Western world, it can get fatted out and out of proportion pretty fast, because you need shelter, you need food. Okay, well, because I was talking a couple of weeks on this podcast, when I first moved to Newcastle, I was paying $1,000 a week in rent, which is a premium thing. And that was a luxury within that need. So I've since moved $700 a week rent. So I think...
it was just fulfilling a different need. So your coffee's a really good example. We've just drunk I don't know how much this was, a kilo, but this was a single origin Rwandan coffee. that's a lot more than a Nescafe,
Topsoil.
or indeed topsoil, or even a home brand
Yeah.
beans. It still fulfills the nutrition and hydration need, but it's fulfilling something else. And it's this search for...
Well, this is nice. The topsoil isn't. And I know that's subjective. But...
That is subjective, but that's a different need. That's about the beauty of the crema, the aesthetics of the cup. There's a whole bunch of needs that's fulfilling. And so by downplaying travel or experiences as if they're not as important is leading you into a scarcity mindset. Now, taken from a 30,000 feet, that might sound like privilege, white privilege, but it's more about a way of thinking about stuff, that if you start with the need that you're trying to fulfill and then work out the best way to fulfill it, you'll get to a better answer. And so all of these decisions are trade-offs. So spending today means less spending tomorrow. Spending less today means more spending tomorrow.
I got asked the question at a seminar at the end of last year, and one of the questions was, how can I keep focused on my goal and make sure that I can achieve it, or something like that? Like, how do I achieve my goal without distractions? I'm like, well, your goal isn't serious enough and you don't want it enough.
Yeah.
Like, if you want that goal, there won't be distractions.
That's right.
And that's the trick, right?
Yeah.
And that's the way to tie the money plan in. If the goal matters enough, then when the hurdles come, which are generally I
Weekly.
should be spending on this crap, but I am, that will hinder the ability to do the big Europe trip in a few years' time.
So it's the why. I think you might have mentioned start with the why. Why am I doing this? And that's what's going to help.
But this whole thing, and we see it in so many questions in the Facebook group and when people email in and Instagram and all that, it's, I want to know what's the best financial outcome for this money, where it's not about how do I get the best return for this money, because that's making a financial decision. We need to make a lifestyle decision. We need to make a life decision. We need to make a decision for us, what we want our life to look like, and then plug the money into that.
Yeah. And that's why rules of thumb like save 15% for retirement just don't work, because that's an assumption that you want a lifestyle in retirement that is arguably better than the lifestyle you have during life. That might be the right answer for you, but it might not. And that's why, we're not spreadsheets. We're humans, and you've got to start with...
We're human beings, not human doings.
That's very deep, Glenn.
Well...
Did you make that up?
No, but I've been on a journey, Vincent. Hey, a regular pest in the Facebook, Daniel Quinn.
G'day, Daniel.
Hi, Daniel.
Why the platform you invest on in the long term makes so little difference to the long-term outcomes, so you may as well choose the best one you like. So I think that's a comment. We'll take that as a comment, Daniel. But
I'm not sure I agree with it, but let's take it as a comment.
So he's basically saying if you like the vibe of the platform, just use it. Now, there is another question here that we'll get to around, I think, tax at retirement and transferring into pension accounts and all that nerdy stuff. But I might even just use this opportunity to ask you, Vince, and this is not a paid ad, I just wanted to ask Vince because I actually haven't, and Jimbo hasn't asked much about it. You have Life Sherpa Invest.
Yes.
What is Life Sherpa Invest? And is that a platform that someone like Daniel could use? And do you need to like your platform?
And that's why I was about to say I disagree with Daniel's point. I think there's 2 points there. The question that we often see in the group is, should I use this broker or that broker? And this guy's $5.95 a trade and this one's $7.95 a trade. That is third order noise, and whichever UI you like.
Yeah, but you see it, everyone's like, oh, the Vanguard platform sucks and all that. Like, yeah, it probably does, but who cares as well? Like, because if the mechanics of the platform work out and the underlying investment's good, the UI, yes, it's annoying, but then it goes to what reporting. But yeah,
But to go to Daniel's point, I mean, that if you're looking to invest, there's a bunch of things you have to be able to do. First of all, investment is fundamentally an asset allocation decision. So can I get the asset allocation I need in this? Can I access the right funds? So if I go to Vanguard, I can mostly buy Vanguard funds. Surprise, surprise. So can I get what I need? Does it give me tax tracking? Because number 2 after asset allocation is tax. Number 3, does it come at a reasonable price? Am I getting the right return for it? And am I comfortable with the provider? So all of those are, I guess, second order decisions. The third order decision is, do I like the UI?
but as well, I think, and this is where it gets complex and we need the time to discuss, this question of pick a platform and get on with your life, I think it is fundamentally different. If this is your first time you've tripped over a money podcast, you don't have any money invested outside of super and you've got a spare $500 or $1,000 or $5,000, like literally just pick one and jump in.
Yeah. So there's a distinction, I think, in Daniel's point about when you just get started, the amount you save is what matters. So the fact that you've saved $50 this week is the biggest decision. And does it really matter whether you pay $2 in fees or $3 in fees? So the getting started bit at that sub $5,000 level is what matters. And the lessons you learn about yourself are worth the price of admission.
Yeah, and then it kind of goes in. It's like, so James is talking about people that might have a spare $2,000 or $3,000 a month to invest, right? I call that, and it's not the technical term, but in my books, I talk about when you've got wholesale money kind of relative to your world, that's real money.
Yeah.
And sure, $100 a month might be real money to you, but even $100 next to $2,000 or $3,000 a month, $2,000 or $3,000 a month is real money.
It is.
And we need to be sure that when we put it to work, we pick the most appropriate kind of structure, platform,
Big time.
and then investment last to make sure that all the ducks line up.
Yeah, but at that sort of beginning, to get started, what matters is you actually get started. So if you can say $50 or $5 or $100 a week or a month or a fortnight, something like can I mention brand names here?
You can do what you want,
Something
Vince.
like a raise where you got roundups and a bit of gamification will get you started. And the lessons that you learn about your own behavior there is worth every cent of the fee. People argue about whether, I don't know how many dollars a week it is, but it's not a lot of money. But once you get to 5,000 or more, now what you're doing with the money matters. And that's where you now need to start focusing on what it's invested in. The getting from 0 to 5,000 is the getting started bit. Now you've taught yourself that, yes, I can do without this $100 a week or $1,000 a month. And now I should be doing something
and
about
I can
it.
leave that money in an investment account without pulling out for
That's
rego.
right. So this is all about that behavioural stuff. So once you get to that 5,000 stage, now asset allocation really does matter because that's now the foundation for what will become 10,000, 100,000, whatever, over your lifetime. It might become the deposit on your house in 5 years' time. It might become the school fees for Chloe when she goes to high school. There's a whole bunch of things it can become, but it now matters that the earnings on it matter, whereas at the beginning it's about getting started, which sort of leads me back to Life Sherpa Invest.
Yeah, but before that, and this is what just shats me to tears, online, Facebook groups, on Reddit, people ask a genuine question, hey, what platform can I use to get started? And they get spooked off by someone using a technical term. You got to make sure it's CHESS sponsored.
Do this, do that, yeah.
And these prescriptive things, which if I'm getting started with $500, just if the app looks good, use it. Because the more you get invested and the more you learn this ecosystem, you'll learn more about that product. Like just buy something on something and stick to a plan.
And Vince, on Life Sherpa Invest, we'll get to that in 1 second. Just quickly though, before, like when you're investing, that is the key, right? You've got past your $5,000, you've got your emergency fund. Please make sure you're clear on your goals.
Yeah,
right.
absolutely.
Make sure you've got your values and your goals clear, because Chloe's education in 12, 15, 20 years time, maybe depending
Who's
on when
Chloe?
This is the
The mythical
Vince's
daughter
mythical
going to high
daughter.
school.
The daughter you
We-
never
we-
had. Can I be the daughter you never had?
whether it's high school, but if it's a 5-year home deposit, then the platform, so to speak, Daniel, might be very, very different to, you might be dumping that into super. You
Might be the
doing all
first home
sorts of
super
other
saver
things,
scheme,
right?
and not even a platform. Yeah.
And maybe that's the broad sense of a platform, is where are we going with this money, right? There's a technical term around platform too, but if we're thinking about, well, where does it go? There are so many options. It could be an investment bond. It could be super. It could be, okay, great, we're going into the share market where Life Sherpa Invest, I'm sure, is pretty helpful.
You're going to need to put that mic in your face, bro.
Yep. And so then it's about saying, well, when do I need to access that?
So what is Life Sherpa Invest? Because I haven't heard you talk about it until just recently.
Oh, that
Is it still shiny?
it is still shiny. So Life Sherpa Invest is the way that we've been able to make the portfolios that we've delivered to our members with advice over the past decade or more available directly to people with no membership, no advice. So we have 4 risk profile portfolios that you can buy online, invest from $5,000. It's fully managed. It's the same evidence-based investing that you'd get as being a Life Sherpa member, but you can get there from $5,000. So we've got 4 portfolios ranging from the highest growth at 90% growth assets down to a conservative 50%.
And these portfolios you have been using in your business with your clients for over 10 years.
That's right.
So you've got some track record.
Yeah. So our 10-year return at 90% growth is 10.1, 10.2.
Is that good?
Which is pretty good.
Yeah.
And so,
Just ask him.
Yeah, just asking.
but it's evidence-based. So for personal financial investing is full of myths and rules of thumb and stuff that goes back to history. Sell in May and go away. October's a bad month. September's a good month. And this just goes back to look at the evidence. It's based on Nobel Prize winning research, not mine. Lots of far more intelligent people than me. But we've used that to build portfolios, largely ETFs. So the principle being asset allocation, what matters. And if that's what matters, then getting it is pretty important. And knowing that you've got it is pretty important. So highly transparent, very low fees, and primarily ETF based.
Do you have a 5-year return off the top of your head for a portfolio?
I emailed it to you this morning.
Oh, did you? Let me have a look.
While you're looking,
Yeah.
transparency. I love that you brought that up, Vince. I love that idea. Isn't it interesting when we have there's one of our conversation points with a client, right? You want to dig into, well, does transparency matter? And some people are kind of a bit unsure of what that means, and so we kind of dig into that, and we'll think about super funds that hold things like unlisted assets. And what does transparency mean? You can see exactly what you're holding and exactly what it's valued at, ideally every second of the day. And so, yeah, that transparency part is something we should dig into at some point, because
so you can go on our website and there's a list of the ETFs that are in it today.
I'll do that now. What's the website?
Invest.lifesherpa.au, or you can go to the normal Life Sherpa website. The 5-year number is 8.5.
So if the 5-year number is 8.5, VDHG was 9.09. So no, it wasn't.
I'm sure it's not.
Um,
Certainly at the 10-year number, VDHG is about 1.5 below ours.
Really? Just make sure your mic's in front of your mouth. Okay.
I don't know the VDHG 5-year number off the top of my head, but we have a big graph on our wall that tracks them.
Yeah, okay.
And I tell you that we've got a higher return at lower volatility.
Yeah. Okay, so I'm on the website. So if I go to the Everest 90, learn more, and I go down.
So that's a 90% growth assets, which means shares, real estate, infrastructure, and the 10% is gold.
So on the front page, so do I click learn more?
Are you on the
Yes.
Life Sherpa homepage?
Yes. No, I'm on the invest.lifesherpa.au.
So click left, learn more, or scroll down.
Yep. Okay, learn more.
We'll take you to each portfolio.
Okay, it's got an Australian share breakdown, but it doesn't mention the actual fund.
It will do right down the bottom of
Not on this page.
I can't see what you're doing.
Yeah, I must be on.
But I can give you the list off to. So our Australian large cap shares is VAS, as you'd expect, the Vanguard Australian Share Fund.
Oh, okay. Sorry, it's at the bottom of the main page where the individual portfolios show the weighting.
Yep.
Potentially. Yep.
So they're all built from the same components.
Yes.
So the Australian share component of the Everest 90 will obviously be higher than the Australian share proportion of the Kosciuszko 50.
Yeah.
Kosciuszko, poor little Kosciuszko there, the 50-50.
Well, you will possibly note that they're in order of height. We believe in scaling financial summits.
I have noted.
And so our US exposure is IVV, the iShares S&P 500. We use the Vanguard All World for the rest of the world.
The OC Microcap, did they change their name? Who's that?
That's OC. They were Orchard 10 years ago.
Right,
But it's been OC for a decade or not. So that's a really interesting point. So this is what I'm talking about in terms of the evidence-based allocation.
Yeah.
That when you look at the research, there are 5 main drivers of equity returns. Obviously, there's the market return, which is what you're going to get if you buy VAS.
Yep.
There's small companies generally outperform big companies. They're harder work because there's less research. There's hundreds of analysts following the top 300. But once you get out of the top 300, you're obviously taking a little bit more risk.
Yeah.
And that's why you should get a higher reward. And so we use a couple of active fund managers in that space. And you really need to be active, mostly because there is no index. Well, at least not a tradable index, an investable index. And
so the micro cap, it's smaller caps than the small cap.
It's X300, generally.
Which is interesting at the moment with, obviously there's a huge push towards passive investment, right? And the media hypes it really hard. And lots of people we talk to that come out of this community as well are like, look, passive, that's our thing. That's all we've done. That's all we'll ever do. But that micro cap, even the small and mid cap side of things,
and
there's a good argument for a little bit of that now.
And I really hate that word passive because there is no such thing as a passive investment. Your choice of an index is an active decision.
It's still a decision.
So by choosing to invest in the ASX 200, that's an active decision because that's a decision to invest in, firstly, Australia, secondly, equities, thirdly, large companies.
And fourthly, banks and mines.
Fourthly, banks and mines. And generally value companies, that is companies that are trading on relatively low price to earnings multiples with relatively low growth prospects. And those two indicators, obviously a good sign of higher returns. And a choice to invest in the S&P 500 is a choice to invest in the US market, to invest in even larger companies, to invest in predominantly growth companies, to invest predominantly in tech companies. That's an active decision.
I guess you're looking at what approach might that fund manager be taking, and that's much more passive, right? But
and I like to use the word rules-based rather than active or passive.
Yep.
That the S&P 500, for example, is not actually the 500 largest companies in the US. It's got a set of rules as to how it chooses them. And but it's sort of become the marker of the market. So if anyone asked you, well, how did the US market go? They'll probably tell you how the S&P 500 went because that's defined to be the market. But companies generally outperform in the period leading up to going into the index.
Yeah.
So if you look at
so company 503 Probably did really well the last.
Well, Tesla, for example, was probably, well into the top 500, like possibly top 50 before it actually joined the index, because it didn't satisfy all the other rules and didn't make it through the committee that decides which 500 are going to be there.
So they don't just use a straight up market cap?
No, it doesn't just go, well, just sort these companies by market cap and draw the line at 500.
But that's because there could be like fluctuations.
Well, there's a few reasons. There's obviously the fluctuations that you don't want to move 501 in and then next month so it goes from 501 to 499. You don't just put it in because next month it might be back at 504. But it's got profitability rules. So it needs 4 consecutive quarters of profits to get into the the S&P 500.
So I just looked up 10 companies that weren't in the S&P 500 10 years ago. Dell, they were added in September 24. Workday Inc. was added in December 24, which is, it's a pretty big move there. Tesla in 2020.
I mean, Tesla's a prime example. Most of its outperformance happened before it was included in the index. Lululemon's another really good example. And it delivered huge performance in the period leading up to it. And you can see that. If you just go and look at the volume and the trading history, you'll see this big spike on the day it gets added, because most index fund managers are being appraised based on tracking error, which means, and tracking error can be positive. It can be positive or negative. So, but they're not willing to risk seek out a positive tracking error because it could just easily be negative, and people look at the raw size of it. But back to your point, yes, we generally look at index managers for big funds. So if you're buying large cap US shares, it's pretty hard to go past a fund like IVV, which is practically free.
Do you guys reckon the Dow Jones is not the best barometer? Like if you had to pick a fund to look at every day to see what the states did, are you taking S&P 500 or the Dow?
Oh, the Dow's sort of become
because it's a bit old now.
It's become a bit of a historical
dinosaur
thing that it was 23 companies when it started. I think it might be up to 30 now.
I'll read the companies in the Dow Jones: 3M, Amex, Amgen. Don't know what that is.
They're a drug company, I think.
Okay, Amazon, Apple, Boeing, Caterpillar, Chevron, Cisco, Coke, Disney, Goldman Sachs, Home Depot.
Exxon.
Sorry.
Exxon.
Not sure. I'll keep reading. Home Depot, Honeywell, IBM, Johnson & Johnson, JP Morgan Chase, McDonald's, Merck, MERCK.
They're a drug company.
Drugs.
Merck shut down.
Microsoft, Nike, Nvidia, P&G, Salesforce, Sherwin-Williams. Is that a top 4?
Don't
maybe? Travelers Companies. Don't know what
Insurance.
that are. United Health Group, Verizon, Visa, and Walmart. That was as at 2000.
Yeah. So, and it's not a market cap weighted
Today-ish.
index either. So it tells you something completely different. It would be an expensive index to run an index fund on because of the way it trades. You'll have much more turnover. I mean, it was the only game in town pre-S&P. When's S&P? 50s? 60s? Like, it's not that long ago.
Yeah, not sure. Yeah, interesting. So Life Sherpa Invest, who should use that and why should they?
So this is for people who want a done-for-you solution and believe in the efficiencies of markets and want the tax all taken care of, want the rebalancing taken care of, want that portfolio construction, but they don't want to pay an advisor.
Right. So would you say Life Sherpa Invest is a robo-advisor?
You could call it a robo-advisor. I'm not sure it's a term that we use, but you could. What's
the difference between Life Sherpa Invest and a competitor of yours, a different style, like a...
It fundamentally comes down to the portfolio construction methodology. So compared to probably the leading player in this space, we would have more components in our portfolios. We have an allocation to small cap companies, which they don't. And over the 10 years, that's accounted for about 0.5% a year of that return. we have a broader diversification, including things like real estate and infrastructure.
It's all just to be clear, the infrastructure is listed.
Correct.
Cool.
Yep.
But it's through
And it's unhedged.
and through a managed fund.
It's
or
an index.
Okay, I'm just having a look here.
Yeah, so it's an unhedged,
Being global infrastructure.
Yeah.
Oh, yes. I can see there.
which is
Yeah.
a core infrastructure fund, which broadly means roads, railways, power stations, airports, utilities.
You're not doing any Australian commercial property.
No. There's enough in the ASX 200 or 300 to get you there.
Yeah, true. Yeah,
So unlike the US index where you don't get much real estate,
yeah.
You-
Like if you buy the ASX 200, you're getting GPT, you're getting Dexus,
Yeah.
you're getting
you're
Goodman,
getting,
Yeah.
and
West.
the whale fund, what's it called?
Stockland. No.
It's two names.
Goodman Fielder. No,
Sounds something like
Yeah.
that,
That's
but
bread.
not
that's
Goodman's.
bread. Yeah,
Not Goodman's.
GPT,
No,
Global Property Trust.
Their main fund's called the Whale Fund, Long Whale Fund.
I'm just going to get that up for us, Jamie.
Bring it up.
Whale Fund.
Without an H,
Oh, okay.
as in weighted average lease
Whale
expiry.
Fund.
What the hell are they called?
Oh, Charter Hall.
Charter Hall.
Yes. I actually, in my mind, I had the little square and the local shopping centre.
So you don't get that in that predominance in global markets. And of course, globally, the US is a huge part of it,
Yeah.
which is another probably differentiator that we split out the US exposure from the rest of the world.
Oh, because of the concentration in the
So-
world.
So that we don't really want to allow our global exposure to become dominated by the US. So it's active-ish in that sense, that we take an active sector position. We don't trade it. We don't change that over time, but we certainly wouldn't have wanted our US exposure to climb that far.
So this is a legitimate question. I mean, all my
All
questions,
questions are
yeah,
legitimate.
all my questions
Not
are
all
legitimate.
answers are.
Not all answers are. In theory, I've gone to Life Sherpa
Yep.
or invest.lifesherpa.au /Everest 90.
Yep.
Right. I can literally see your asset allocation.
Yep.
38% Aussie shares. I can go back to the page before and say, of this portfolio, there's 30% in VAS.
Yep.
So you basically have given all your IP away publicly.
Yep. So
Global shares, 29 to 30%. So you could theoretically, if you wanted to, go to invest.lifesherpa.au /Everest.
you can copy our homework, yes.
Yeah.
And
So
if you're going to
why-
copy, you should copy from the smart kid in the class. But
Yes.
yes.
So why wouldn't I just do it myself? Why do I need you guys?
Great question. That is a legitimate
It
question.
really is, because
There's a few reasons for that. Firstly, you're buying the ongoing rebalancing. That's automated. You're buying the ongoing changes to those portfolios. So those active funds will change from time to time. Indexes change, funds change. So those components will change from time to time. You're getting tax reporting, you're getting performance reporting, and you're getting access to funds that you actually couldn't buy. So you couldn't actually buy those two active small caps unless you were investing about $1 million.
yeah, I was going to say they're wholesale entries.
No, they're retail, but they do have a minimum investment. There's a $50,000 minimum,
Right.
and you buy them direct from the manager rather than going to your broker.
They sit on other platforms.
Are they all? I mean, you can buy them on other platforms.
Yeah. Just
Do you use NetWealth?
Yeah, we use it. Yeah.
Yeah, so you could buy them on
You can
NetWealth.
do them on NetWealth, for example. That's a different setup.
So,
Keep your mic on you.
so,
young man.
so yes, you could. If you were investing $1 million, you could reproduce that portfolio. And the
Set an alarm to check Vince's website every
yeah,
month.
you could.
Rebalance myself.
And the question is, well, why would you bother to save 65 basis points? So just to put that in context, on a $10,000 investment, that's $65 a year.
Yeah, so what are we doing here? Yeah. Yeah.
That's right, $65 or $650.
650.
No, 650 would be 100,000.
Yeah.
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 Yeah, so $65.
Yep.
That's about $1.10 a week, maybe a cup of coffee a month. So But yes,
Depends how much you value your time, right?
Yeah,
And
and
other
you
things.
need a solution to solve the tax reporting. So ShareSite Pro will go and cost you $30 a month.
Yeah, so
so
you're there anyway.
so yeah, but that's the downside.
So-
That's the downside of transparency.
Yeah, who doesn't this suit? Like, why wouldn't everyone just go and rock up and use and put $5,000 in it? Or is there a minimum? Is
Yeah,
there?
there's a $5,000 minimum.
Yeah.
And you start getting discounts on the fee above 500,000.
Yeah.
But generally, if you're a trader, this is not for you. If you want to tinker, this is not for you. If you want a human advisor to talk to, this is not for you.
See James.
So if you want to invest $100,000 and you want to talk to an advisor every quarter, well, that's not our business.
Yeah.
Different setup.
Yeah. Okay.
And it doesn't include strategy. This
Sure.
is a pure investment solution. So if you're smart enough to know that 80% growth is for you and you've got $5,000 or more and you just don't want to do it yourself,
Can I set up one of these Life Sherpa Invest things in my self-managed super
you
fund?
can. So you can invest in a family trust. You can invest in a
I might actually do that.
a self-managed super fund.
I was texting Jimbo the other day. I'm like,
You can
got
have
a
a
bit of
kids
cash
account.
accruing in the old self-managed
where's
super
it going?
fund, and
You can
but that's the thing. Like, my biggest problem is I want to get involved.
Yeah.
And I think doing something like this, or I'll even go there, doing something like this, or even a one-stop shop ETF, it just remove you are saying out loud that I don't want to tinker my portfolio. I know my reason for financially living is to get a job, earn money, spend less than what I earn, and invest the rest. And that invest the rest part, I'm outsourcing either to a one-stop shop ETF portfolio, a Life Sherpa Invest, because I understand the science behind it. I like the portfolio.
I know what I want.
I know what I want.
Yeah.
Or I go to superannuation. I'm not getting involved. I'm literally outsourcing the investing part, and I'm focusing on printing money in my day job.
Yeah. So this is exactly the same portfolio you would have been invested in before you moved to a self-managed super fund.
I used to be a client of Vince's.
So, and it's the same portfolio that I invest in.
Why did you swap out Ausbil for OC?
That's because Ausbil closed to new investors, so they had a soft close. So, and that's a really good example of stuff changing that you've got to keep on top of.
Because I've booked Arden Jennings, the portfolio manager of Ausbil small or micro caps, to come on.
I'm a big fan.
Yeah, I like their Ausbil, been around for a million years, and they're a great product. But what are they relaunching the fund
No, it's
with
just
a different mandate?
closed to new managers. This is the micro. They have a small cap as well.
I think it's a small cap.
Okay,
Sorry,
but the
Yeah,
micro-
they have,
Saw.
some of their funds are still
Oh,
rocking
emerging
and
fund, I
rolling
think
for
it's
sure.
called.
Yeah.
So
Either way, I think he's got a bit of both.
Yeah.
But anyway, I
Yeah.
booked him in because I think all that active managing in the outside of the top 300, it's sexy stuff.
Oh, and it's good for the community to hear it.
Oh yeah, I love it.
It's
Makes
so
you want to
good.
buy every stock they talk about.
Yeah, but that is definitely an area where if you read the literature, much of which is put out by index vendors to spruik the use of indexes.
It's funny because it's like, this is the problem every time you listen to an Equidates episode and Bryce and Ray are talking about this roughie out there, you want to buy it. And,
and
you've got to and I think, hey fellas, had lunch with those guys the other day and we were just chatting, but I think that comes back to knowing you need to know what you don't know and you need to know your behavioral limits. Yeah. So that could be, Jimbo, I've got $2,000 a month free. I want to engage with some quarterly coaching and money and all that stuff. I'm going to allocate $1,800 a month to wealth and life. I'm going to keep $200 so I can buy little speckies.
Yeah.
Yeah.
And the same thing, or it's like I've got $5,000 a year.
To carve out your play money,
effectively.
basically.
Yeah.
Yeah. I take my play money down to Randwick on a Saturday.
Yeah.
But just the point you made about Ausbil's a really good one. So, people talk about passive investing. Indexes change. index funds change. So beta shares in the last month have changed one of their bond funds, which used to be a 50-50 Aussie, 50% Aussie, 50% hedged global, and they've now changed the mandate to be 100% hedged global. That's
huge.
Whoa. Calm down. 100% hedged global bonds. Why?
This is one of their green bond funds.
Right.
And I think it's the scientific answer is because there's a relatively small supply of Australian green bonds.
Right.
The marketing answer is, coincidentally, they just launched an Australian-only green bond fund.
Right.
So the direct comparison is now put 50% of your money in one fund and 50% in the other.
Right.
But
okay.
This came out as one of those emails that all investors get that everyone ignores. But that's a fundamental asset allocation change to your portfolio. So if you weren't on top of that, and you might have decided that, yes, I'm now going to take half that money and stick it in the coincidentally launched Beta Shares Australian one, and now I'm back where I was. But that's a decision you have to make, and you have to be on top of it. So there is no set and forget solution, and that's where a professional portfolio manager can help.
100%.
And it keeps you away from shiny new objects.
Now, Life Sherpa Invest, can I be an Instagram influencer and talk about it? Is it chess sponsored, Vince?
No, it's not chess.
Because if it's not chess sponsored, how can I talk about it?
That's right. Well, legally it's a managed investment scheme.
Right.
So there's a PDS. It's held by a responsible entity.
And that's not
us.
You in your garage at home.
That's not me. It's a company called Open Invest. So they are.
Oh, they've got size.
They hold a AFSL, Australian Financial Services license to be a responsible entity. The underlying shares are held by one of the really big custodians. Just can't remember who it is off the top of my head. And we provide the intellectual property. So they do all the admin.
Okay, so they
trading,
provide the platform, the admin, the tax report, but you've plugged your IP into it.
Yeah. So they pay us for our...
Is that the same as Owen's portfolio, what he's doing?
Yeah. So he's with one of the competing platforms.
Right. Okay. So have you compared yourself to their...
I haven't looked at his yet.
Yeah. Okay.
But yeah, that would be a perfectly rational comparison to make.
Yeah, okay. And I think that's the whole thing. It's like, because everything's transparency, right? If you can see it, this is what we do.
Yep.
This is the asset allocation. We take care of this. We take care of that. Here's the fee. Like, there's no boogeymans or mans.
You know what you're getting, and you're going into it with your eyes wide open, and it's simple.
And very low-cost brokerage too. It's 0.1% capped at $9.50.
Yeah.
I mean, I don't know what you pay a typical retail broker, but
$5.95
might be as cheap as it gets.
Yeah. So why wouldn't I... So what's the actual difference? You said it's a MIS scheme, Managed Investment Scheme.
That's how it's regulated.
Yeah. So it's not an MDA.
No. But you do have a beneficial interest in the underlying shares, so they're treated as yours from a tax perspective.
So if I put money in through my super fund or my own name or whatever, and then I'm like, nah, I want out. Can I get out?
Yeah.
And do I trigger a tax event, or can I in specie in or out? You
can in specie, but not for $5,000. You can't.
Yeah.
But yes, if you have a big enough a portfolio, you can in specie out. They're yours. You don't have a HIN. You've got an interest in a managed investment scheme, which does create a bit more of a clean structure if you're debt recycling, for example.
Oh, yes.
So from a debt recycling perspective, if you take a traditional MDA type structure where you have a cash account where your distributions go and the sale proceeds of your rebalancing and your new contributions, that's creating a pretty murky pool of assets, some of which might be deductible and some of which might not. So this way, the custodian's receiving the distributions. You can tell, I want to take 100% of my distributions out, and then you could choose to reinvest, or you can choose to reinvest.
Okay,
but if you tell me, tell Open Invest, I want 100% of my distributions paid to my Up bank account,
They'll do it.
they will do it.
Okay, because this is the dance, right? Because all these brokerage accounts and all that, it's annoying that I can't pay my distributions off platform into a normal bank account or back onto my mortgage.
Because you don't really want them being mixed up with proceeds of sale.
No,
So if you,
because a proceed of sale is a different item in the ledger. Effectively, it's
That's
not
where-
income; it's a sale event. Yeah,
I mean, that's where a more technical platform helps. Because you can either, I mean, with what you're saying, Vince, you've got to move, you can make it, you can tell them what to do with it, with that particular part. You can do that with like a net wealth, for example, and say, so you can put your income in one spot.
yeah, just
for
comes at a slightly
example.
higher price point.
Yeah.
Also, well,
And depends where
more
you-
importantly, it's there's a fixed fee component,
Yes.
which means it's for larger portfolios.
large portfolios.
So we use a platform. We don't use NetWealth, but a very similar platform
Yeah.
for these portfolios for our advice clients because they're larger amounts. Ours doesn't have a fixed fee, but that's sort of academic. But it's a more full-featured exercise. It's designed for an advisor-client relationship.
I think the bigger challenge with debt recycling is making sure you get the debt part right. Right?
Yeah.
Because then if you've got interest-only loan here, home loan over here, where's the money going? Making sure
Yep.
we've got our investment debt structured in a way that it remains investment debt.
That's right.
And
And
that
there's
we're
not a lot of mortgage brokers are on top of this. So you,
No, absolutely not.
and in fact, they're not even licensed to be on top of this anyway. That you
well,
do.
they have to do it in
Yeah,
collaboration.
So if you went to a mortgage broker and said, I want to do debt recycling, like literally, you've actually got to say to them, you need to do it this way.
Yep.
You shouldn't be saying to them, how can I set this up?
because they're not
that's-
licensed to tell
We've got a client who went to see a broker before they met us and has just said, "Hey, our broker said we can go up to 80%. We want to debt recycle, and here it is. Let's go." Like, okay, hang on. Let's step back a second. Firstly, debt recycling is not for everyone, and you got to really have your head screwed on and be ready for it if that's the goal.
A lot of people, when they do the debt recycling, they're just leveraging, like they're just gearing.
because they are two different things.
Yeah.
Which I think there's a lot of traffic in the MMM group and many other groups on Facebook where this is a very hot topic, and we certainly get lots of people coming up to us on the website going, that their opening gambit is, I've been investing for a while, I know what I'm doing, I want to debt recycle.
Next level, yeah.
And there's certainly big savings to be made. So if you're investing $100,000 and you're paying 6% on your home loan, well, 6% of $100,000 is $6,000, and if you're a 47% taxpayer, that's a $3,000,
Big time,
$2,800
But
savings.
you just want to make sure you got a bit of an income portfolio. If you actually want to recycle the debt, you need to take income off the table to pay down to
that
repeat.
would help. Yep.
Yeah,
Like
and
it's-
it's also the principle you can make out of your own capacity to pay a loan off too.
Yeah.
So
But the
you've
thing
got-
as well, like, so you could basically, in theory, and I don't know if you've actually done it's probably going to be hard to do, but if you could almost do a very clunky debt recycling by buying hugely growth stocks and selling them down, paying the CGT and then paying off debt.
You could.
Like,
But obviously there's the challenge, well, if I've sold the asset I borrowed to buy, I now have to use that proceeds to pay down the debt. Obviously, you can take your profit off the table.
yes.
But it does start making things fairly complicated, which is one of the reasons why being able to separate the income coming off the portfolio from any
Capital.
sale proceeds
critical.
is really important.
Yeah,
And that's one thing that this does out of the box without any smart thinking. So if you want to do debt recycling on your own, guys, this is a good strategy.
get a good mortgage broker.
Well, get them good.
Also-
Well, just get some advice and tell the broker, I need it structured this way.
Sure. So that's really the development. So it's for people who want to invest. Maybe it's the core of their portfolio,
Right.
and they're going to play with
10% outside or
whatever
something.
it is
Yeah.
outside.
And the reason I'm asking is because I actually haven't fully ask. I'm like, I might as well ask you all these questions while we've got it pressing record.
But transparency is the key to it. And the risk of that is, well, you can copy my homework.
Yeah, that's right. But I can get a plans online from a building company, try and build it myself, but it's going to be pretty average.
And you've got to be right on top of it. So it's not for people who want to, for whom investing's a hobby.
Should we throw another log on the fire?
Yeah, let's do that, and we'll just be back right after this. Okay, Miriam, for young adults, really pull apart if they should buy an investment property first or PPOR, and how to access equity in an IP to buy a PPOR.
That's a lot of abbreviations.
We will park that secondary point because that's a potential debacle. But in this current climate, I honestly think if you are a young Australian and you have got a good income, you can save money, and you think, I need to buy a house, a lot of people living on the east coast of Australia or within a couple of hours out of a capital city, you might need to cough up 800 to $1 million to buy your first house.
Yep.
I'm talking freehold house.
Now, just put some numbers behind that. 16% of properties for sale in New South Wales are under the stamp duty exemption threshold, which is 850, 800,
800.
Yeah.
16%.
So
It slides up to $1 million, but
yeah.
There's 1 in 6.
yeah.
So should a first home buyer be buying the most expensive 5/6 of property? Maybe not.
Well, does that carve out units and townhouses?
No, that's dwellings.
That's
Yeah,
everything.
okay.
Yeah.
So that's what I'm kind of saying. If you are hell bent on buying your first home to live in, freehold property, not townhouse, strata, just Torrens titled every day, whatever they call single title. I think in this climate, we need to say, why would you want almost $1 million in non-deductible debt?
Or because the alternative is paying non-deductible rent.
But the alternative is, if you're that hell bent on buying a property, I'm saying buy an investment property somewhere else and rent where you want to live.
I mean, the maths doesn't support that on a like-for-like basis. That's a lifestyle decision.
That's right. So
the traditional...
I'm just saying, lifestyle-wise, that is a lot of debt to carry.
Yes, it is.
And to even get to that option to carry the debt, you're going to have to save a lot of money for a lot longer than 6-7 years ago. I just think the playing field is so cooked at the moment. And, where are we? Newcastle. Like, what's a house worth in bloody, I don't know, what's a suburb? Like Garden Suburb or something like that.
$1 million at least.
Like, who's buying? Yeah. You just need I don't know. I just think if you're that hell-bent on property, go buy an investment property somewhere.
Yeah, but that comes back to why you're buying it. You're asking two questions and conflating the answer there. So the two questions are, should I rent or buy where I live? And then if I'm going to rent, what should I invest my deposit in? And then that's either other real estate, and that other real estate might be interstate, or shares or Bitcoin or whatever it is that you want to invest in.
It definitely comes back to lifestyle, right?
But the math says, like for like, the rent, if I take two identical properties and I say, look, I have two choices. I can buy that one and live in it, or I can buy that one, rent it out, and rent that one. Mathematically, the buy where you live over, once you get past the negative gearing piece, is always going to be better because the way the tax works.
No, but I think I'm saying most people where they want to live, they can't afford to buy. So just
Well,
forget it.
yeah, but that's a lifestyle decision. So
Yeah.
if you're saying, and in Australia this is always true, that you can always rent a property for less cash today than it would cost you to buy it today. So typical rental yields in Sydney are 3 to 4, which says a $1 million property is going to cost you $650 a week probably to rent.
Oh,
7 maybe.
yeah, probably more, a bit more.
So whereas borrowing money at 6 and putting 10% down, it's a bigger.
It's going to cost
I
you
think
more.
But that's a lifestyle. So
yeah,
that,
it's hard to also say because depending where everyone lives as well, like I can have a lifestyle decision if I live in regional New South Wales with a decent income to buy the house and it's pretty cheap and affordable, but I can't make that same lifestyle decision if I live in Roseville because
So
I
let's
actually
look
can't
at it-
afford a house there.
Let's look at it differently. If you're
but you probably could buy a 1-bedroom unit.
so
But
if
it's
you're
not going to suit
Miriam,
my needs.
Well, but if you're going to rent in Roseville,
No, but that's what I'm saying. If you grew up in Roseville and you're hell bent on saving to buy a house there, you can only afford a unit. Forget it. It's off the freaking table. Go and rent somewhere else or go buy somewhere else.
sure, but that's a different decision.
Yes.
That's I'm choosing not to live in Roseville because I want to move out from home.
Yeah.
I have to make that decision because Roseville's now too expensive.
Yeah.
so go the other way and look at, okay, Miriam, you're a young adult. Should you invest first or not? Are you in a position to buy
Yep.
the principal place of residence that you want? And can you, maybe miraculously, if you're in the 1/6 in New South Wales, for example, can you get it with some concessions? Can you save it in a way that makes sense tax-wise? Could you
home
be
super saving,
dumping
yeah.
money into super, get a first home super contribution going? That's a super effective way to save some deposit. Can you then move into that place affordably, handle the mortgage, handle everything else? Does doing that actually make you happier than renting? Does it make you feel more secure? Are you young adult? We can't assume you don't have kids, but if you don't, are you planning kids? Can you afford something that's going to work for the next stage of life? When is that potentially going to be? Our first home was a unit. We lived in it for 5 years. We didn't have kids. We moved into a larger apartment. We were in a 3-bedder. We had both kids and we're working from home in that place. And it was in a great spot in Sydney. We've rolled out of that into a 5-bedder now where we're working from home and it's working for the growing family. But you don't have to buy a house first.
No.
And if you can do that, and I know for us personally, that's been our most successful asset so far, outside of maybe the business and things like that. Our most successfully growing asset has been the home that we've lived in. And that's not necessarily always going to be the case for everyone.
Well, just so happened
But-
you lived in Sydney.
You also can't
We're in-
spend it as long as you need to live in something.
Yeah. So, yeah, there's some forced savings that's kind of helpful there as well. I love a bit of forced savings.
Yeah.
Yeah, I don't know. I just think it's so cooked. And I think I'm just talking bang for your buck. Like if you can see like someone like Pidge who can sniff out a potential good little investment that can get you kind of started on this journey if you want to buy property. Because I think the first question is, do you want to buy a property to live in or to invest?
Yeah. And I think you sort of I think the first decision though is, do I want to rent or buy where I live?
Yes.
Right? That's the first decision. And for many people, an increasing number of people, the answer to that question is rent. Now, the next question is, well, in order to build wealth, I need to be saving the difference between the rent and what it would cost me to buy this property. So what do I do with that money? Do I go and buy a cheaper property elsewhere, a property that I might not live in? And the question is, well, why are you buying property? If the idea of buying property is it's a nice investment, then it sort of doesn't matter where you buy. You just look at the numbers on the property. The answer is, I actually want to hedge my ability to buy a property where I want to live in the future. And the only way to do that is to buy a property where you want to live.
Yeah.
And certainly you can borrow more money, as a general rule, to buy something to rent out than to buy somewhere to live, depending on how you're going to live. Certainly, if you're going to stay at home with mum and dad and buy somewhere to rent, that's a good way of building some wealth. You do have to forego your first home buyer benefits and be willing to wear the negative cash flow for quite some time, which is getting bigger as rental yields have fallen and mortgage rates have gone up.
Yeah.
But this goes back to, for Miriam, and whether it's, I don't know, if it's for her daughter or her, I don't know.
But if your goal is to buy your home, then buy your home. Don't go screwing your ability to borrow by taking into other big mortgage somewhere else. If your goal is to build wealth, then...
But it does actually always go back to strategy.
Yes, absolutely.
And it's like, what do you want your life to look like? And how do we go about that? And it could be a timing thing. Like for me, I knew I wanted to buy my own house to live in, but I wanted to invest and build my business first. Because if you get that part right, you buy any house that you want.
We actually had an interesting client situation recently. Good couple, one daughter, earning good money, and in one of the capitals in Australia where they can afford to buy the place they want to live probably for the next 5 or so years. And they could also rent there and do a whole lot with their spare cash flow, right? And so we actually ran 2 scenarios where we looked at what if you buy, and these guys are fairly gung-ho, they're switched on, they're fairly sophisticated from knowing what's available, and they understand the concepts when we're discussing it with them. And so we ran the scenario of buying the place they want to live in, keeping some cash aside, debt recycling that, and playing with that and going pretty hard on the investment side at the same time, and or renting, so no debt recycling because you've got no debt to recycle, and doing other things with that. And in the end, the buying the place to live was definitely the better outcome, no matter what sort of reasonable property returns we put on those. And I guess the big thing underneath that is it satisfied they're pretty unemotional. These guys are different to most clients where they're like, we don't care. We've got a young family, but we don't care if we rent for the next 10 years. We just want to be better financially.
I think what's coming out of me when I get squeezed with these questions is it's just, there's a lot of people out there in Australia, good, hardworking people who are earning, 70 to 80 to 90 grand a year, 75 grand a year. So a couple really hard workers might be 140 household income, might have kids, don't own a house. Like, good luck trying to save to buy a property.
Sure.
And, you can cut expenses all you like in the world. So, Uncle Maslow's hierarchy walks in and be like, there you go, you've met all your needs. So that's it. No luxuries here. But it still doesn't change the fact that you can't save 90 grand over the next 10 years or 8 years or 5 years or whatever it is to save a deposit to get into a nice house. And I think it's a seismic shift in Australia, and particularly in Sydney and Melbourne and Brisbane to a point, but I know Sydney because it's been in the media recently lately. It's for governments, it's easier to go up and cheaper because don't have to build new infrastructure and highways. So the next version of Australian people, Mark II or from whatever we are at, you're going to be buying an apartment to live in if you want to live within 2 hours of Sydney.
And that's a lifestyle decision.
It is. But I'm just saying, even on the Central Coast where I grew up, here in Newcastle, go up, like, what's a house worth at Coffs Harbour? Like,
still probably 600, 700, 800 grand.
Like, where does the average family with kids and working hard, because there's a lot of people on 75 grand a year or less, good luck. And that's what's just like, it's really annoying and hard. And I get, like, I'm online a lot. I talk with a lot of young people, and I'm acutely aware of the challenge in Australia at the moment with property.
Yeah, this
So-
is a huge change that that over the past, since the late 90s, what's that, 30 years ago, the price of property has grown way faster than incomes. Some of that is capitalising the easier borrowing. So as we went from single income households to dual income households, we went from 20-year mortgages to 30-year mortgages.
I think you can almost get a 40 now.
Yeah, there's a couple of 40s.
I mean,
and all that's been capitalised into house prices because the demand has exceeded the supply. And that's making it tough. So although the mortgage as a percentage of income, because they're now dual income households instead of single income households, hasn't changed materially, it's the deposit that cripples you. And that's despite the fact that Australia's built more houses per head than any other country in the world apart from Switzerland, I think. There's one country, I think it's Switzerland. And yet our native population's not growing.
We're still not catching up with the demand, though.
Yeah, but that's largely immigration driven.
Yeah.
So you
but we
could
need the immigration to, like, you look at aged care, like there's just no workers.
Yeah.
Like there's so many industries where
huge numbers of overseas workers. So, but that's a trade-off that we as a society have to make. And is it actually practical to build that many houses? Because where's the labour coming from? Where's the materials coming from? Where's the land coming from? And the trade-off maybe we have to make is that more people have to live in units.
But no one wants to be that person.
Well, that's a societal decision,
Yeah.
and it's not my place or your place to tell people what they should
I
buy.
don't mind apartment living.
I'm loving being an empty nester and living in a unit.
I'm loving my empty nest as well. All my kids have moved out.
My parents are downsizing, and I never thought they would. But they're downsizing in size and upsizing in cost, moving from Grafton to Newcastle. But out of the garden, out of all the things they've loved forever, but they've made the call. It's easier, and that's where they're at.
See, my parents, they moved into a unit in Brisbane. Dad's not loving it.
Okay. I tried to talk my dad turned 90 last year, and 25, 30 years ago, I tried to talk him into downsizing from the big family home split over 4 levels with stairs everywhere and a huge garden to look after. And he was going, I just can't find what I want. I can't find what I want. And now he's regretting not having done it.
Yep. Okay.
Not that he needs the money. It's just that now they've got this huge house and they're starting to struggle getting up the stairs. And they've got to have a cleaner to clean it. They need a gardener to look after the garden. It's all just becoming a pain. So, obviously these are all lifestyle decisions as we talked about.
Back to that client, right? Or you think about those people. They're 140 grand combined income. They're not able to maybe buy in a capital city as a result, especially if they've got kids. They're thinking about all this stuff. I'm in the middle of training some newer advisors in our team, and one of the things that we've been through recently in this process is telling someone that they're not actually on track to achieving the things they want to achieve. And whilst that's confronting as a new advisor going, I've got to have this difficult conversation, and they're not going to be that happy about it. I'm like, well, hang on a minute. When you show someone exactly where they stand, you've just created insane value for someone. If you can go, look, this is the reality right now of your exact situation, then they've got decisions to make, right? Do you want to do something? Is there something you can do, right? You may be, and that's privilege speaking, right? You can't just go and pull all the levers and get bigger jobs and do all these things, but are there opportunities within that? Is there more that you could earn in a different way? Do you really want it? How much do you want this job, or how much do you want the house that you can't afford right now? And if, it might actually reframe some of the goals, because so many times people are working towards things that society has told them to care about. And in Australia, it's a house, right? It has to be a backyard. Got to have the pet running around in the backyard, got to have all those things. Well, hang on a minute. If you can see exactly where you stand, all of a sudden you go, okay, well, I know exactly what I have to do that, or maybe I reframe my goals.
Well, there's obviously trade-offs up the line.
Sure, there are. But, the one thing that you can't get when it comes to money is certainty. What you get out of the right advice and the right teasing those things out is clarity and confidence.
Mm.
Once you've got those two, life actually becomes pretty comfortable.
Big time.
So now that may smack a bit of privilege. So you go, well, you can't do that. Well, you can't do that and do all these other things. So where's the no in your life?
Yeah, pick one.
Pick one. And certainly when I look at money stress, the two biggest causes of money stress are too much house and too much car relative to income, because they're going to make up 40, 50% of your lifetime spending. So get those two decisions right. And sometimes they're direct trade-offs.
Yeah.
That like you can have the BMW in the driveway, but you can't have a driveway. Or if you want a driveway, you can have a
Corolla.
Hey,
there's another question here just on this property thing. Mitch said, what interest rates are good interest rates right now? And where do you go for values research? Maybe
property value research?
There's like a website, propertyvalues.com or something.
There is.
I think most domain and real estate have it all built in anyway.
Yeah.
Additionally, how long after securing a loan do you go back and question your rate and look to get a better deal, and how should that conversation go?
Yeah, I mean, that's an interesting question. And when we talked earlier about the difference between mortgage broking and financial planning. Quite often with a mortgage broking discussion, the opening gambit is, what's your rate? That's the first question people often open the discussion with. And the answer is largely, well, which category do you fit in? So sometimes...
before you do that category, he said, for context, I got a loan back in November. Yeah, probably wait 10 minutes, bro.
Yeah.
And I'm on 6.19, 30
That's a pretty
year.
good rate.
95% LVR. That's a good rate.
That's a really good rate.
That's a great
for
rate.
95% LVR.
Sit
with
tight,
about,
Mitch.
And yeah, I thought you said bitch. Yeah, there you go, Mitch. Sit tight, bitch. Yeah, and I've got another 5% in an offset account currently as an emergency fund. I mean,
well, I mean, the bigger problem is, well, why are you borrowing 95% and paying LMI when you've got 5% sitting in cash?
well,
That's going to cost you way more than the interest saving you could move.
Yeah, well, we don't know if the emergency fund 5% rocked up last Thursday
That's
or
true.
at the time of.
Well, presumably any sensible first home buyer would have an emergency stash in place
Yeah,
first.
if that's a 600 grand home, a 30 grand emergency fund's not wild, depending on the situation. But
especially if you work out the cost of replacing hot water service. 6.19
for
for
95%
is a very good rate.
Yeah. And so on the, just so everyone can understand how mortgages work, it's all risk and risk spectrum. So the more you borrow against the value of the place, higher risk. Higher risk means the bank need more of a premium for taking on that risk. So that means, higher interest rate, and you have to pay LMI.
And they also know there's fewer options to borrow 95%.
That's right, and that's why you really need to go to a mortgage broker if you have a smaller deposit or a 5 to 10% deposit, so they can actually find the most appropriate lender for you. But, all these amazing rates still in their fives that you might see advertised, you probably have to have a 60% LVR. So at that rate, if you $1 million property, the loan you're getting is $600,000, so you've got $400,000 of meat. You won't be paying LMI. You'll get a really good rate because the risk to the lender is so low.
Yeah.
So it's all got to do with risk with lending. And you look at the complete other end of the spectrum, high interest rate on a credit card, 20%, it's because it's so risky because the bank hasn't got it secured against anything. They don't know or really care and can't know realistically how certain your job is. Like they can't come and repossess the $5,000 worth of lunches and jeans and steaks that you purchased. So unsecured debt, higher risk to the lender, higher return.
So the point I was going to make was that
higher interest rate rather.
Policy first, price second. So can you borrow what you want when you want against the property you want to buy? That's the first question you got to answer. And how you make your living, what your income looks like, how much documentation you've got, what multiple of your income do you want to borrow, how close to the servicing limit are you, what's your LVR. All of those things will go to affect price.
And I think for Mitch, it's also then, okay, November, it's pretty fresh. So you're not reviewing your loan straight away. I'd give it 2 years. And
12 months, I might come up for air.
12 months perhaps. And like that's when you start paying the loyalty tax with a lender, right? You've become less shiny. But 2 years, 12 months to 2 years, I'd say 2 years is a good move, especially if you set it up with a mortgage broker, because you're going to cause them for a clawback if you go and they're going to lose what they got paid generally within 2 years as well. But regardless of that, Luke, Mitch, probably the main thing is you're at 95%. You're probably limited in lenders anyway. But if you've got the ability to really punch that loan down a bit, then maybe your trigger is, okay, I've got to 90% or I've got to 80%, even better. If the property is growing in value, keep an eye on that, because that's a really good chance to then refinance to an even better rate potentially.
Yeah. And you've also got to look at people get a bit hung up about the second decimal place on their interest rate. So if you've got let's call it $1 million loan to make my maths easy, 0.1% is $1,000 a year.
Yep.
Isn't it? Or is it 10,000?
1%.
No, 1% is 10,000.
Yep.
So 0.1 is 1,000. I'm having a bit of a mental blank day on the maths.
Yeah,
It's Valentine's Day and it's Friday afternoon, Vince.
Oh, that's probably what it is.
Yeah.
And I've moved time zones. So, when you look at the costs of moving, so you've got some government charges. You've probably got $500 of government charges. You've got application fee. You've got a shed load of paperwork.
What are we doing here?
So you got to put things in perspective. So I'd really be trying to look at, can I save 0.25 or more to move? And getting a variable number in the high fives is a really tough job these days.
Yeah.
If you want to get, you can get in the mid fives if you want to take a 3-year rate.
You probably wouldn't at the moment, would you?
Yeah, you can do 565 for a 3-year rate.
Yeah. Well, I don't know.
That's not a recommendation.
No.
It's just saying these are available.
Yeah, yeah. Which basically mean a rate decrease is priced in.
Yeah, but the bank's not taking a punt on the rate.
No.
That will be backed out by some fixed rate in the market.
Yes.
And the 3-year, there is actually a dip in the yield curve at 3% at the moment. That's 3 years. So it's a tick-shaped curve.
On the property thing, we've got probably, I think, maybe the most liked post is Luke. Luke said, how do we go about using equity?
Yeah, and this kind of ties on to the question before from Miriam about access the equity.
The second part.
Yeah, in the investment property to buy PPOR. So that categorically you don't want to do, and it might come out when we talk conceptually. So what's the best way to do this? To use $1 million purchase. So $1 million.
Yeah, we're talking the first one or the second one?
The first one.
Okay.
So your first property is worth $1 million. You have a $500,000 debt on it. So it's sitting at a 50-50 LVR.
Yep.
We know that in magical bank land, 80% or less LVR is good, and you won't have to pay LMI. And when we refinance, you don't theoretically have another 500 grand of equity. You might only have
300
on
your numbers.
Sorry, 300 of equity.
Unless you're a doctor or a lawyer.
Yeah.
When maybe you can go 90%.
Or whatever, yeah.
But yeah.
So in theory, with $1 million house and a $500,000 existing loan, you have $300,000 of usable equity.
Subject to being able to service that loan.
Blah, blah, blah.
But
Yeah.
So then we rock up to the mortgage broker and say, hey, I want to get equity out of my house. And they go, yep. So they go, yep. Assuming that you can borrow another $300,000 and your income can support that, regardless of whether really in the initial stages what you're using it for, because we can say it's to renovate the kitchen or something, right? They might send out they'll go, yep, this lender here is good. They'll send out for evaluation. The valuation came back at $1 million. We got 500 debt. And I said, yep, you can borrow up to 300,000.
Go get that Lamborghini.
Go do it. Go get that Lambo. Then what they do is you will then and if it's for an investment property or whatever, they might use some rent to help service, but this is in concept. Effectively what they would do, if you were going to buy the $300,000 Lamborghini, they would just set up a second mortgage. So you log into your internet banking, $500,000 mortgage, first mortgage. There's a second mortgage there of $300,000.
Can you say second split?
Second split or second mortgage.
It's the same mortgage.
Yes.
Different split. Yep.
Yes. Yeah. So then you can take that $300,000 and buy a Lambo.
Or take it into Randwick. Yep.
Or whatever you want. But if you then wanted to buy another $1 million investment property, assuming that the numbers stack up, it's really hard without drawing this, you effectively $300,000 of security.
Yep.
Because it's not equity, it'd be security.
Yep.
You would end up with, and I guess it just comes down to the mortgage broker, but generally speaking, there would be one mortgage on your property of $300,000, and then the $700,000 mortgage,
ideally with another bank.
Would be secured against that property.
Yeah. So you now have $1 million of debt against which you have to service out of your $1 million property you've just bought.
Yes.
Or out of your normal income.
Yeah. And that 300 becomes your deposit, essentially, on the new place. And then you're borrowing, call it 700 if it is, probably interest only.
And maybe some costs as well.
Yep.
Some stamp duty.
Some costs and all that wrapped in there.
Yeah.
So maybe you're buying for 900 and you've dealt with stamp duty and all of that. And then, you've got that separate loan, which is secured against the place you're buying a loan, which creates a secure line between the two. So if one goes pear-shaped, the other one's still okay in the bank, especially if you're in two different lenders. But even if you're at one, you're still you're in a better spot when you cross. At least you self-secure those.
Yeah, you don't want to cross the security, so it's one pool. If it is with one bank, you want to do this mortgage here is against that property there.
Yeah. And then, of course, I mean, usually the limitation is, can you actually service this new loan?
Yes.
With the way property prices have moved over the last decade, there's lots of people with lots of equity, which is really just the capitalised value of future rent. Like this is not real new money. It's money you can access to invest today.
Yeah.
But it's not actual real money.
So in theory, if we go back to the original example, if we did that $300,000 equity release, we weren't buying another house. We were just $300,000 mortgages set up, second split, $300,000 direct into CVA shares. That $300,000 split, that portion is tax deductible.
Yeah, the interest on it. Yep.
The interest. And that's important to remember. If we go back to Miriam's question, if you were renting and you had an investment property worth $1 million with a $500,000 loan on that, in theory, you've got equity in that property that's usable of $300,000.
Yep.
Now, the reason why it's potentially not advisable to take that $300,000, put it towards the house that you live in and borrow the balance of $700 against the mortgage is that $300,000 that's against the investment property is not tax deductible. So we don't want
quite often selling that, if you buy your investment property, retaining it can often be a bad idea.
Yeah, John and I actually answered a question recently on the show. I don't know if it's up yet or if this will beat it, but she was renting or she lived on site with a job somewhere. So she good income, doesn't pay rent. I think it's a bit regional. She's got 3 investment properties. She was basically like, what do I do in 3 years when I move back to Melbourne? And we're pretty much like, you're probably selling 2 of the properties to buy a house with cash, because then you can borrow against that house that you own to then go and buy other investments.
And quite recouping the stamp duty implications of doing that. can be a really fast payback period.
And then there's that other strategy, or this common scenario that comes up with so many of our clients, is the upgrader strategy, right? So you go the other way. If Miriam bought her PPOR, her principal place of residence first, she's been pumping money into paying that loan off. Let's say it was $1 million. Now she's got 500 grand and she wants to upgrade the home. So since buying that place, she's
not renovate, like literally move out.
Find a bigger house.
Yes.
Buy a new property.
Buy a new house. Yeah.
Quite common. Yep.
And everyone's goal, almost.
I'll keep it as an investment
keep
property.
that. I'm going to keep that as an investment.
Yeah, that is such an emotional attachment.
I did it.
Which lots of people do.
Printed money.
And
in most cases, you will generally be better off selling it and buying another one.
Because you can sell it tax-free.
Yeah, but play this out with because you're going to talk to mortgage structure.
So you play that out. You've got a $500,000 mortgage on the place that you're moving out of, and you're going to try and buy, let's say it's a $1.5 million house now because you're over the $1 million home.
Yep.
You turn that into an investment. You can use the equity, right? Like we were just talking. You can draw that up. You can draw that extra 300 grand up to 800. That pays a deposit on the next place. Great. We're into that one. Let's say the servicing of the loan works. That's all okay. One of the most common misconceptions is that amount we just drew back up because it's coming from the investment property. Oh, great. That's tax deductible now. I can go 800 grand's tax deductible debt.
You might want to Google Part 4A of events.
No, that's just not deductible.
No, but if you do deduct it, it's probably Part 4A.
But then you end up
tax avoidance.
So you end up with $1 million debt or more, probably 1.2, 1.3 million, 1.4, 1.5, depending on how much cash you've saved. You essentially owe 100% of the new place that you've moved into, which because you're living there, that's where the money from the other property went towards. That's all non-deductible debt. So it puts you in a really inefficient
so
spot.
that's when I purchased Blue Bay as my first home in 2015. I just paid and I'm a big believer in principal and interest. All right, there, I said it. My investment property is a P&I, and that's a behavioural thing as well. And I'm
forced savings, Glenny J.
Yeah, but I'm not that kind of property guy who's like, I wanted the empire. I want 20 properties. We're going to leverage up.
30 properties in 30 months?
I don't want 30 properties in 30 minutes or 30 months. So my properties, principal and interest, it slows me down. It enables me to have the forced savings because, hi, I'm Glen James. I'm a recovering spender. If money's in my wallet, guess what? It grows legs. So all my properties, principal and interest, okay?
The point I was about to make.
What I was going to say, Blue Bay, principal and interest, offset account, any additional extra money or savings, didn't pay that down. And then when I left Blue Bay, if I was going to buy another house to live in, scoop the money out of the offset account, put it straight into my new property that I'm going to live in, and I haven't dicked around with the deductible mortgage.
And that might be a good reason to pay a higher rate on
to get
your
the
loan,
offset facility.
To get the offset. So you can buy a no-frills home loan, which might be 0.2% cheaper, but won't come with an offset.
Yeah, and and this is why we need to say out loud, if you want to buy a house and you're happy, we're going to buy this house, we want to live in it for the next 20 years, we just want to pump the mortgage, it's okay to get a vanilla mortgage.
Yeah.
Not everyone has to get an offset. We don't have to get 15 linked accounts. It's all good. Just be aware of each. Vanilla has these restrictions. The advantages are it might be a better rate. Offset account, you might have to pay $500 a year pro pack. The rate might be 0.2 higher. You get the offset accounts. Redraw facility, probably don't go there because it can get messy fast if you want to keep track of stuff. But if you want to live there forever and you can manage your money well and you don't care that it's all, kissing each other and mating, it's Valentine's Day and all that together with the mortgage redraw, knock yourself out.
And that, the interest-only argument before, go back pre-COVID, interest-only was usually the same price as principal and interest. And so if you've got an investment property, it was sort of a no-brainer from a tax perspective and cash flow perspective to do that. Today, it's costing you
0.25.
0.25.
Yeah, and that was an APRA tapping the banks on the shoulder.
Yeah, it's a cost of capital argument that they have to set aside more capital.
Responsible lending.
So it costs them more. And so now you can say, well, yeah, sure, I can keep my money deductible for longer, but I'm paying more actual dollars out the door. Is that the right trade-off?
And I think I've probably just been in a good position where I can afford P&I on all the properties, and my lifestyle hasn't suffered, and I'm still investing elsewhere. And so
I'm not certainly a big fan of principal interest on your home.
Oh, absolutely, yeah.
And it's getting harder and harder to do interest only on your home.
Yeah, and the extreme version of that upgrader strategy is that, right? Interest only, everything's in the offset. That's your deposit for the next one. But, I mean, even pulling that off, it's dangerous because you're likely to spend, most of us are likely to spend the money.
Well, that's why
we
banks
save
love offset accounts, because you see this whopping great sum of money sitting there and it's connected to your FPOS code. So you go tap, 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 and it disappears.
And people get really excited about offset accounts, but really when you go look at the numbers again, 10 grand in an offset account for the year.
Well, that's sort of break even on a lot of cases.
Just break even. Like $600.
And the bigger your loan, the bigger the break
when
even.
the lower rates, it was pretty much, if you don't have 25 or 30 grand cash, forget it.
Yeah, and the bigger your loan, the bigger that break even point is.
Big time.
But yeah,
so we're doing a lot of no frills loans today.
Yeah. I see, like if the shoe fits, ignore all the noise online. You just need to know what you're doing. Yeah, so part 4A is the general anti-avoidance provisions.
Right. Yes. Blatant, contrived and artificial arrangements.
Yeah, and on that note, always put ATO before you're searching Google around tax, right? ATO and then the tax question.
Oh, so at least the ATO website.
Actually, the ATO community...
You're not reading the wrong part.
The ATO community board's actually pretty good.
Yeah, it's good.
The ATO website sucks. The amount of stuff that's not up to date on there, it's wild. And sure, it's a big website. For the Retire Right newsletter, we were sending a newsletter out about TTR. And what was it? So remember, if you're still working between age 55 and 65.
There's none of those people anymore, though.
No, but there was something around... No, this is TTR. Like it's the pension's taxable. Remember, it used to be tax-free, the TTR, but they made it taxable at 15%. So it's basically a super account that's taxed for the TTR. So Jess wrote the email, and I forget what it was, and she wrote it, and I'm like, oh, I know I'm out of the game. And this was like 3 months ago. I'm like, I know I'm out of the game, but I think that's wrong. I said, Jess, where did you get this info? I think that between 55 and 60 that you've put there is incorrect. She's like, I got it from the ATO website. I'm like, Then
but given where that transition is,
there
is nobody under 60 who can have a TTR anymore.
Yes.
No.
Yes. But my point was, I'm second guessing myself. I'm thinking, oh no, the ATO website, she's done the research, because Jess will prep all our emails and I'll check them. And I sent a screenshot to Marty, or I might have sent it to you and Phil. I'm like, is this right? And then Martin's like, oh yeah, ATO's wrong. So I don't know if wrong, not updated, but that's why you just have to be very careful with all these different websites, that you're not just going full wholesale, pulling the trigger on something that's an out-of-date information, because even the Money Smart website.
The Money Not So Smart.
Yeah. The amount of errors that you still see on there. It's so wild. And that was set up by ASIC as a good thing for the consumers, but the amount of change that happens year on year with tax law and federal budgets and all that stuff, it's just so scandalous that there's still so many errors on the Money Smart website.
I mean, it is hard to keep up. I mean, we've got 140 something articles on our website, and just the cycle to go through and just go, well, that rate's changed.
Well, even, my first book, Sort Your Money Out, the publisher's been on my back to refix it. The amount of changes, I'm like, this is a job. I just can't be bothered. And so it just moves so fast.
So we have a rolling cycle where we review it, so many articles a month. But, it takes a long time to get around there.
Yeah, totes. Any other quizzes that are good?
Rebecca asked there, any advice on how a couple, so this is what we're talking about before retirements, transitioning, on how a couple with an age difference might handle one retiring quite a bit. So 10 years, quite a bit, 10 years plus before the other. So one of the couple is older, might be ready to retire a good 10 years before the other, what to consider, et cetera, et cetera.
I mean, there's a whole bunch of lifestyle questions around
Big
that.
time. Are you okay working while the other one's
And then there's
not?
the financial question.
Yeah.
So, are you going to get access to the age pension? So you might want to
Shelter some money.
move money into the
super.
younger person super.
Do you put more super into the older person because
so
they
you can get access
it
to quicker?
earlier?
So lots of things, but the
yeah.
psychological things of someone retiring, just what does that mean to do you still get up at 6 o'clock in the morning? All those things are just hugely household dynamic issues.
Absolutely.
Mm.
When I started the business, I had 3 months of leave of notice period, and I'd given notice, and I was out the door a week later, and I had all this time, and I could not surf or mountain bike more. And I guess the outcome, my end summary of that 3 months, yes, we're starting a business, and yes, there was lots of work to do with getting that moving, but it almost felt a little bit like retirement because the phone's not calling, right? You've got to do things. And so in that time, you have to find a way to fill the void. And it's way, way harder than you think.
Yeah, I had it's not directly on point, but I had an interesting chat. I went to visit my 90-year-old father last year who'd been playing golf up to well into his 89th year. And I went down to the golf club with him and met a few of his golfing buddies. And I was talking to one who was younger than the rest of the group. This guy was still in his 60s. And I just talking about why he was playing golf. And he said, because it fills 5 hours a day.
Yeah.
That it had become so much of a chore that he just needed something to fill his day. His wife just did not want him around the house. So golf for him was a way of filling 5 hours.
Yeah.
Now, that's not a way to spend 30 years of retirement. So getting to those, what are you retiring to? And given that most people retire at a time not of their choosing, that's a real challenge. So you do need to be preparing for this
Big time.
without having that sense of countdown. 363 days and 5 minutes to go.
Yeah.
Which just destroys all enjoyment in your work.
I reckon we've had 4 clients that I can think of that have retired in the last 2 years or so that have all gone back to work.
Well, I tried it twice.
How are you going? How is it? Well, funny you should ask, James. I need another accumulation fund because I'm dumping money back into super. I'm earning again.
Yeah, and that's the whole thing. Just do something you enjoy. Don't wait. Don't work your ass off at something you hate doing so you could get this retirement age in 15, 20, 30 years. Just
Fool's gold.
Yeah, make the change today. There's a question here that I wanted to just... Kira, do you need to go?
No. Just the fire embers are getting a bit low.
Yeah. Well, we'll come back after this break.
And there's no more marshmallows.
Kira said, do you need to ensure you are in a super investment option that allows in-specie transfer when moving into pension phase? Canna Campbell often mentions this is important. So
I'm sure Canna would manifest her retirement.
I'm not going to comment on that. I don't partake in such manifestations.
Pass.
So it's probably less... Well, it probably is about the option, but the structure of the fund.
Yeah. I think this is the elephant in the room when it comes to super that nobody wants to talk about.
How dare you?
And it sort of didn't matter until 2007, but since Peter Costello created the tax-free retirement income, it matters a lot. And so who was the questioner?
Kira.
Kira. So the point that Kira's alluding to is that in most pooled large super funds, the unit price includes an accrual for capital gains.
Of all members.
For all members. And it's the only way to be fair to people coming in and going out. So just to put some numbers on that, if you buy a BHP share today in your own name, you pay tax on the dividends this year and you pay tax on the gain when you eventually sell it. So if that's in a super fund, the BHP share that was bought 20 years ago has this huge capital gain in it. So to be fair to people coming in and going out,
They spread it.
the unit price includes an accrual for that.
Yeah, it's reflected already.
And so while you're in accumulation phase, that doesn't really matter. But when you go to retire, the day after you retire, your tax rate is 0. So you'll never pay tax on that. But the way most of the big public funds are structured,
They'll take the tax anyway.
you have to redeem your accumulation units and then subscribe for retirement units in either that fund or the other fund that you
Something
choose.
else, yeah.
So, so how do you get around that? You need a
Self-managed super fund with
Well,
3 off-the-plan units.
Well, that was the only answer up to 1999. But since 1999, we have these things called super wraps or investor-directed super accounts.
I'm talking about off-the-plan property in your
Oh,
super
yeah.
fund, Vince.
And so that allows you to effectively just tick a box
Yeah,
and this
so just a
capital
quick
gain
flick.
disappears. That comes at a cost. So the platform's a bit more expensive. But, that could be 5% of your retirement balance. So if you're invested in largely index funds, 40, 50% of your income is coming in the form of growth, which in a segregated account will never be taxed. So the modelling that we've done is that that's worth about 0.3% a year.
Yeah, it's worth a bit.
I forgot to ask before, does Life Sherpa Invest, is there a super trustee or is it ordinary money?
That's ordinary money.
Yeah, okay.
But they're the same portfolios that you would buy if you
Yeah,
got
that's right.
super
But
advice
you're
from us.
not effectively saying to people, bring your super over to Life Sherpa Invest.
But watch this space.
Ooh, look out. You heard it here.
But that is where that transition into retirement makes a difference.
It does.
If you're sitting in an industry fund or one of those big pooled funds, you don't have control over it, and you're not necessarily able to also, on the flip side, then direct, well, where does the money that I'm drawing back out once I've retired come from? And that's where that idea of a wrap account, so to speak,
So, okay.
allows you to split some of that out.
Yeah.
So for those playing at home, in theory, we've got $1 million super balance at age 60 and we've retired.
Yep.
And we want to access that to pension phase. And we've got a portfolio of 6 ETFs in that fund. It's on a wrap account.
It's just tick the box.
It's literally
A journal entry.
a journal entry. So one day the second day they'll set up a new account, and in the background just move those across to the pension phase without selling down and having a tax event.
Yeah, it's just a book entry. There's no physical
But
movement
if we were
of the
doing
stock.
that with a big super fund, $1 million overnight, they create the pension account, but there's been a sale event
Yeah, you have to
and then a
redeem-
repurchase.
That's right. So this is not a industry fund issue. This is any
Master
pooled,
trust.
any pooled fund where you've got a
Vibrating there,
unit price.
Vince.
And it's not his phone, if you know what I mean.
And so it's a problem that was created by the change to zero tax
So,
super
so
funds.
what is the answer?
Well, the answer is
Cop it on the chin.
well, no. The answer is there's two answers. There's the complex issue option called the self-managed super fund. That's got a lot of hairs on it. A step too far for many people.
Mm-hmm.
And the halfway house, which gives you the tax benefits without the compliance problems, is a investor-directed portfolio service, sometimes called a wrap account.
Yeah.
And then on that, it's not the case of at age 60, we move from an industry fund over to a wrap account because there's a sale event that will have to happen.
So
You're
you won't-
planning ahead.
Yeah.
You're doing that
you won't
earlier.
in specie out of an industry fund.
So the modelling we did, once your balance gets to $60,000 or $70,000 and you're 10 years or more from retirement, you should be seriously considering it.
But there's going to be business as usual rebalances and all that at the time, but it's that wholesale. We need to move the whole portfolio into a different structure where we can do that just with a book entry, where when it's a pooled fund, it's going to be a sale event.
Yeah, and this is 5% of your retirement balance, guys.
Yeah,
It's a big deal.
which is a big deal. And yes, there's a cost in one of these platforms, so to speak, right? In the wrap accounts, where there's a fixed cost and there's a percentage of investments. That's why it makes sense to have a higher balance, at least somewhat.
But this is the thing. If you're in your 20s or 30s, you probably want to look at what you need to do to build your super long term.
That's right.
If you're in your 50s or late 50s now, it's off the table for you, generally.
I mean, generally, once you get within 5 to 10 years of retirement, the benefits of moving just for that reason.
Well, they're gone because you've got a sale event anyway.
Yeah, but even 10 years out, it makes a big difference.
Yeah.
10
Well,
years
you're
is enough
still
to
working
make
for 10 years, accumulating. You could be doing 10 grand a year in SG.
Yeah, but you've got 10 years of growth. Like it's
and
a big
SG
deal.
that you're investing. So, that's a good one. It's a very interesting
It's
point.
the elephant in the room, and this is why the media is full of how do you choose a super fund? Fees and past performance, neither of which are reliable indicators of the future. What actually matters is asset allocation and tax.
Tax is such a big deal.
So, let's get it right.
Transparency helps.
Yeah, transparency is important. Yep.
Trying to get a super fund to sponsor the podcast.
Didn't you have a large super fund economist on here?
Yeah,
or-
Brian.
Brian.
Yeah, from ART. I mean, they're a good fund. I mean, I'll
Do they
take-
sponsor?
No, I asked them to come. First hit's always free, though, isn't it? When
That's
you're
right.
going to a dealer. No, I'm like, come. Yeah, absolutely. I said, come talk on the podcast. I won't charge you guys, but you can come on every 3 months and give me an economic update, and I'll charge you. So,
Brian's good with that.
that is good. Like we used to have him. We used to bring him out when we did client events. Got Brian Parker coming. He'd talk to all the oldies, give them the razzle dazzle, and same jokes, same part every time. So, all right, let's have a last look. Is any other things there that are jumping out, Jimbo? Here's a good. There was
There's
one
one
here.
about building wealth if you're not having kids.
Yeah,
That's probably
but
a good one.
before you do that one, Ashley said, "Hey Glenn, what about a comparison of a novated lease on an EV/PHEV, but with the FBT exemption and paying no GST, etc. At
That's
the
a lot of
moment,
three-letter
or
abbreviations.
hot topic.
or getting an interest-only loan from the full amount on your home loan." Ashley, I'm not your freaking accountant. Go and pay for some accounting advice.
But I think there's a few big picture items there that's worth pointing at. First of all, it's not FBT free. It's zero.
Exempt.
It's zero rated,
right.
and the distinction is very important if you've got a HEX debt or family tax benefit A, or
Because they add that back.
because it gets to the extent that you don't pay the amount, it will get added back.
Yes.
But as like for like, a novated lease will almost always be cheaper. I got pulled out for,
Especially on an EV.
and especially on an EV, will be cheaper than buying it, even for cash, especially if you've got a home loan. The downside of doing it is that you have to have a balloon payment. So usually you take like 3 years or 5 years with a 30 or 40% residual. And if you haven't prepared for that, the temptation is therefore to buy a new one at that point and roll it over.
End up in negative equity
And now
by then.
now you end up buying more car. And what really matters when it comes to car is not whether you pay cash or whether you borrow it, but how much you buy
much
and how
you
long
actually
you keep it
bought.
for. And so,
And that's kind of, because I'm having people on to debate me and challenge me of stuff they disagree with me on. And this is probably a good example of, the car thing.
well, you and I have talked about this on
We
several occasions.
fundamentally disagree for total valid reasons. And for me, because, hi, I'm Glenn, I'm a spender. If I'm like, I'm going to go buy a new car and get a loan for it, I'm literally the emotional part of me who Glennie loves cars. I'm like, how much can I probably cash flow a month?
Yeah.
Yeah.
I'd be in a
How much
90
payment can I afford?
I would be in a 90 grand, $150,000 car tomorrow. But because it's me and I like changing cars, just bought that new Volvo, 22 grand cash.
You're making money.
One and done, printing money. So it's, for me, a pure behavior
Exactly.
thing. And the spenders like me, it's just a guardrail and a rule. I just pay cash for cars.
Yeah. So the maths is unarguable, but the behavior isn't.
But if you, and this is the crazy thing, if you want to get into it, the maths is undeniable. The behavior isn't.
That's right.
But if you try and justify a bad behavioral decision because of the math,
Oh, absolutely. Yes,
you're screwed.
that's a real.
And after all these discussions we've had all of these years, I think that's the absolute point.
Yes, it absolutely is.
Because-
They're not dependent items. That's
No,
the
no,
key.
humans
There's
are
so
not
much
spreadsheets.
crossover.
That's right. So, for me,
Despite
I might
what
get
they
a
tell
new
you on
car
Reddit.
every 3 or 4 years because I'm bored and I want a car. Absolutely. It makes more sense for me to get a split on the mortgage or a novated lease, cash flow it, got money at 6%, I can do all the things. But if I justify it, it's a better decision, getting a loan for a car, this buffhead's going to walk in and buy a
Buy a Lambo.
car that I just wouldn't.
I can see you in a Lambo.
No, I'm an Aston Martin boy. Aston Martin. Oh.
DB9.
It's that, when you're coming into age as a teenager and Pierce Brosnan's driving around DB9 in 007.
Well, unfortunately, I grew up with a Lagonda, which is not quite the same thing.
Yeah.
But it's interesting you say that about the behavioural thing about car loans. That's exactly what we do with homes. Because when people go to buy a house, what do they look at? It's how much can I borrow?
Yeah.
And therefore that drives how much house I buy. The decision is not how much house do I need? How much house do I need to satisfy the accommodation needs of me and my partner and my family? The question starts with how much can I borrow? And that's why house prices are rising as fast as they are. It's a human behavioural thing because what we do, as we can borrow more, we do.
Isn't it evil investors, Vince, that are jacking up house prices?
Sure.
I mean, look at the data, everyone. Look at the data.
You just line up immigration and house prices and they are perfectly aligned.
Yeah. The amount of, most property investors, mum and dads, have one investment property. The people that have 3 or more is 2% of the population. It's wild.
It is well.
Because they've already got jobs and that's another part-time job.
And they understand the concept of diversification.
Yeah. So that whole car thing, 100%. So when I was commuting to Sydney in another life, no brainer, novated lease. Work, I had to remind them they need to pass on the GST to me because they're claiming that back, which they did. But all day long. But I think it goes back to your financial life to have frameworks. And it might be, I'm not spending more than 50% of our gross household income on stuff with motors, or 30% or something, just so it keeps you in check. Because
3 months pay.
the first day I got that new Volvo, right? Driving down here at Bennett's Green, rock, window chip. And I was just like, this is why I spent 22 grand on an awesome car. I took Vince for a drive earlier. It hammers, doesn't it?
It does. Shame about the driver.
Yeah, he hammers as well. They just get trashed. And I desperately want an Aston Martin. I can afford one tomorrow, but I can't bring myself to parting with 120 grand for the DB9.
That's where your cash flow
Can you get a DB9
works.
for 120?
Yeah. They're freaking
How
old
old?
cars
How-
now. 9 to 11-ish. Years
2009.
09. Yeah.
Okay.
So
Vince is going
I'd
shopping. Look at
almost
this.
do
well,
Thinking this over.
I legitimately have looked, and I'm like, but then it goes back to, is this the most best use of England and grammar? Is this the most best use of my capital? And so I've resolved, running around in a 20 grand car, they get trashed, they get chipped. I can have just as much fun with the Volvo S60. It's T6, everyone, 2017 model. It's twin power. Do you know what that means, Jim?
Tell me.
Supercharged and turbocharged, all-wheel drive. It hammers. It's a Polster chip, R design, all that stuff. And I can get as much fun out of that.
Does it have a hat on the back shelf?
No, I put that on. But
Umbrella. You need an umbrella.
no. Come on, guys. I'll take you for a drive and you will not ever bag me about my Volvo again. And that just scratches the same itch that, and this is a crazy story, but also not really. I went and test drove we'll call it a brand new Volvo, right? I was just like, I'll buy it, right? I'll buy it. I'm going to have a look. I'm driving this brand new car, like 70, 80 grand, right? And maybe because I am used to having, the Lexus or the Volvo, like a premium car. Like, it's not as if I'm jumping out of a 2003 Daihatsu or something. I just didn't see the step up.
Yeah, the marginal improvement is
like
small.
I'm there, like, so I don't care. And maybe I'm getting older. Maybe I'm spending more money on legal fees and all that in the last few years.
It's been a year.
Yeah.
Like, so I don't know. It's really, I don't know.
Yeah, but back to the question about the PHEV,
Yeah, the
plug-in hybrid.
They're great. Before you go, I hired we went to Queenstown at the end of last year. We hired the Mitsubishi Eclipse Cross PHEV.
Mhm.
I'd buy one tomorrow here. Hammers. So good.
What does that look like? Is that an SUV?
It's a compact SUV.
Yeah.
Yeah. They're great.
Aren't they called minivans?
No. I'm a big fan of Mitsubishi.
They look good.
Throwing that out there. Outlanders. Bought a couple of them before.
Yeah, I can't look at that brand. One of my old aunts, I think she was actually my mother's cousin, but she was an aunt to us as I grew up. She had a Mitsubishi. I think it was what was their really cheap little one?
The Mirage or Lancer.
It would have been a
Or
Lancer.
Colt. How old
No,
are you
it
on
would be
that?
a
Or a
Lancer. It would
Magna.
be-
My
no, it would be a
first car
Lancer.
was a Mitsubishi Mirage.
But she used to call it Mr. Bitchy,
Oh,
and I just can't get that image out of my head.
bits are missing, as they say.
But the point I was about to make was the technology's still moving really fast. So when I bought my current car over a decade ago now, I swore that will be my last petrol car. And I still can't bring myself to accept that this technology's settled enough to buy it.
I think the jury's still out. Actually, I was in Marrickville the other day, and in one of the
Did you have a souvlaki?
one of the streets, there was the council had installed a charging thing on the pole, or
Yeah, Marrickville Council are doing
Yeah.
Or Inner West Council. Yeah.
Inner West. Yeah, I'm like, oh, that's cool. But I honestly, hand on heart, won't do the love out to you salute that our benevolent dictator Elon did. Hand on heart, I actually think the hybrid technology is probably going to be the best suited.
Yeah.
But also whatever,
I
right?
think there's still a
Yeah,
long way
I
to
don't
get
mind
it
it.
to be settled.
But
We're looking at the moment.
Oh yeah, I see.
There's such a long list of
What
options.
are
It's
you guys
killing us.
looking at hybrids or like?
Potentially.
Pidge got Amy she got, I don't know. He got the Prado. She did the RAV4 hybrid.
Yeah, right. Toyotas.
Amazing car. Or if you want to, look after the family a little bit, the NX Lexus is the
Oh, I love
RAV4.
that.
Yeah, we're having a huge debate in our body corporate in my unit block about
Who put the bins out last? Or
No, about installing car chargers. Because we all have power points in our garages.
yeah, but they're not 20 amp. or
But they're
10
not
amp.
20 amps.
Yeah.
Mm.
And so they're talking about taking a few of the visitors' car spaces and installing high chargers.
And what you rock on, you just pay. on
Well, that's
demand.
the debate is like who's going to pay for
Yeah, it's
it.
like, are we doing free
Yeah,
power
it's
now?
a big
are we?
call.
Yeah.
So very big debate.
Mm.
And shall we say the demographics of the block are fairly old.
But as Amar said in the Facebook group, what's the point of anything if AI is going to replace 95% of white collar jobs within 5 years?
Well, I think if the job you're doing can be replaced by AI, you probably have bigger problems because it doesn't. It does some things well that are largely statistical based. So all a large language model is a statistical model says what's the word that's most likely to come after that word. That's all it's doing.
Yeah.
And this is not new. We've had machine learning for 30 years, 25 years anyway.
I think it does pose an interesting question, though. I mean, if you've got kids, I mean, our kids are in primary school. What do you tell? What do you tell
worry
them to
about
study?
what to do? It'd have to be engineering, wouldn't it, or computer programming?
But AI will be able to do all
Yeah,
that,
I think
right?
programming is probably one of the ones that is likely to
Okay.
be turned. Cause,
Okay,
That's the
let's
bit
say
that AI is going
as
to
a hairdresser,
Yeah.
construction, bricklayer.
Hairdresser, boat
so
driver.
hairdresser can't be.
No, not even that.
Yeah,
And, I've spent the best part of a decade trying to apply technology to financial advice because obviously that's something that relies on a human-to-human interaction. The maths bit is easy. The regulatory bit's easy. It's the human bit. And we're a long way from replacing it.
Yeah.
you know all this like ChatGPT and all this stuff. I've just got this website up. Years ago, I'm talking 20 years ago, 15 years ago. You might remember it. You probably wouldn't because you're a surfy little grommet. Do you remember the website Wolfram Alpha?
Oh, yeah. Yep.
So, because everyone's like ChatGPT and all that, I remember using Wolfram Alpha like 20 years ago, and it was groundbreaking because you go in and like, what's the distance to drive between here and Sydney, and how much fuel? Like, it would do it.
Yeah.
Like, this stuff isn't new, but I think it's democratized or commoditized or something.
Yeah. I mean, the world has changed a lot.
Yeah.
But my first job out of uni, I worked for a management consulting firm, and their big thing was the paperless office. Here we are getting very close to that ideal 40 odd years later. So these things will come and the world will change. We're doing different things than we did 40 years ago. An accountant's job is completely different now than it was then. Financial advice was different then than it is now. But these jobs still have to get done. They'll be done in different ways. And the question is, well, what do you teach your kids? I think the answer is they'll work it out. And they
Teach them how to think
Yeah.
and be practical. And I don't know, I'll probably never have kids. Do you reckon I'll have kids? Do you reckon I'll have kids?
Well, you still
I
got a
reckon
few
you
years
will.
in. You still
I
got a
reckon
few
you've got
years
it.
in you.
I've had to press reset on my life.
So maybe you should be asking the question that Benj has asked in here.
Any single ladies? Oh, no.
How does the standard advice on how to focus on building wealth differ if you're not having kids, Glen James?
Well, let me give you the real answer to that question.
I reckon I will.
And that is that statistically, couples with kids do not accumulate less wealth than couples without kids.
And that's a fair call because
Well, because without
average.
kids, spend it more.
You just spend on different things.
Yeah,
so your
100%.
spending on dinners out gets replaced with spending on diapers and child daycare and school fees. Most people spend most of their money most of the time. It just gets spent on different things. So you can achieve the same outcome either way. And having kids should never be a financial question.
absolutely not. And obviously, billions of people have figured it out with no money so far, and we've done okay. But if you go the other way and think about what Benj is asking there, if you're planning to not have kids and you've made that call and you're really clear on it, or you've got to a point where you've been trying and unfortunately it's not working, or whatever that situation is.
And that can be an expensive exercise.
Yeah. But if you're at that point and that's the line, well, then the world's your oyster.
Yeah, I think it's an interesting one because I think what you need to say out loud is, and you guys have had kids, would you say probably, I'm talking hard costs, could be 30 grand after tax a year? I'm talking groceries. Or what did the bank say?
I can tell you the biggest pay rise I ever got was the year Max finished high school.
Yeah, so what,
When I
8
stopped
grand a
wor-
year or something?
Well, I'll try 34 in his
I
last
wanted to
year.
go to
Vince is
friggin'
in
Knox or
Knoxman,
somewhere.
Glenn.
Yeah. Where'd he go?
Come on. St Andrews.
Right. Okay.
It was $32,000 in his last year. It was $7,000 in his first year.
Yeah. So, okay, not all of us have kids that are going to 30 grand schools, but would you say soft dollars 20 to 30 grand if you had 2 kids?
I mean, soft dollars. It's hard.
Oh, sorry, hard
'cause
dollars.
Then it's well, how much bigger house did you buy? It's all of those
Okay,
other things. Right?
assume same house. I'm just like extra food, schooling, clothes.
The ABS equivalised income calculation says that if you take a single person with $100 income, a couple needs 180 to the same income, and each child adds 7% for the same standard of living.
I think I'm probably just saying out loud, if you had 2 kids and it was 30 grand a year of hard dollars that a family would have to pay, like my friends Tim and Krinya, their freaking kids are going to, and obviously do what you want, but it's just, and they know it's expensive. They go to Ninja one afternoon, athletics the next afternoon.
Got everything, yeah.
Like you do
that does crank up.
So
Massive.
I'm like, are you paying like $1,000 a month just on Ninja or whatever? So
Possibly, yep.
Whatever that is. So we'll just say 30 grand a year, 2 kids. I think the answer to it was a Benji, was it?
Benj Nolan.
I would say the answer to that question is be conscious to know that those costs won't be in your life, and because you've made the decision not to have kids, or like you said, James, you can't have kids and it's off the table. Maybe it's like, okay, we don't have that expense. We're going to enjoy each other's company. We're going to travel more. But what if you could actually just say, because of this position, we're going to make sure that we're always investing 15 grand a year extra, and then spend the rest,
and
whatever.
That's what the statistics say, that rather than spending less because you're not spending this, whatever this number is for kids, people just spend it on something else.
Yeah.
And that's where defining exactly what you actually care about.
Yeah.
And if the kids are off the table now, well, then you're clear on that part. Is the rest of it clear?
Yeah.
What else are you trying to achieve? What does life look like without kids? How do you make sure that you're fulfilled? You've got to be enjoying your work. You've got to be doing all these other things. How long do you think you might want to work for? Yeah, it might open up opportunity if you do it right to travel a hell of a lot more, to spend a hell of a lot more on other things that you really enjoy. You might be able to retire super early if that's a goal.
Yeah, my
challenge
cousin
that part.
Carly, and her husband Matt, they don't have kids, I think, by choice. And yeah, they're always bloody traveling and
I mean, I can tell you, my spending went down when Max was born.
right.
Our household spending went down.
Because you didn't go out as much.
Because we didn't go out as much.
But that's obviously a curve that you would map. Like, they start doing Ninja 15 times a week and dancing or soccer.
It goes down initially and it ramps straight back up again at a point. And that's usually when back to work, daycare kicks in. The first year, and we did a session on this where we mapped it all out. And it's part of the book as well, where we did the whole adding kids, not zeros. How do we figure this out? That stage between having them and maybe it's 12 months off for one or both of you, if there's some time off in that first year, that year's pretty cheap. The next one.
Well, not if you look at the net, because you
Well,
just
you're
dropped
not working.
You just dropped a year's income.
Yeah. But the expenses carve off.
So depending on incomes and all of that, often you end up, maybe you're just meeting needs and you're balancing it out. But if you look at spending from last year to this year, big difference.
Yes.
But then it ramps back up as soon as you're back at work.
Well, daycare's a big one. So for a lot of people, spending drops when they leave daycare because school's cheaper than daycare generally.
Do you reckon the government need to get up that whole daycare model where pretty much, you know what, you're a parent, you haven't then talked about doing integrated thing where the daycare is in the same, maybe it's a New South Wales thing, same campus as the school and socialising that daycare like they do for school.
They're pretty young at that point.
Yeah.
I mean,
or I'm maybe thinking about preschool. I'm thinking about something.
Yeah, that was a proposal by, who came after Kevin Rudd?
Was it
What's her name?
Gillard?
Gillard. That was a Gillard proposal to fund.
Or was it
No, it was Gillard, I think.
the Rudd Mark II?
Oh, I don't know which
into
one it was.
Abbott, or
But it's-
was it Abbott? Oh, I don't
But
know.
it's a decade ago or more.
Yeah, I
Some
swear Prue
states
Carr
have-
or someone in New South Wales, they're really looking at this when they're doing
Yeah,
the town.
co-locating daycare.
Yeah,
and
so if you're doing the
schools will
school run or whatever, but I think there is an argument that as a society, and this is, we will wrap up, but if you want to go there, you put my little socialist hat on. Yeah, society can pay for preschool. Society needs to pay for this, needs to pay for that. Like, money's got to come from somewhere. But I think it's a good thing in principle if there was a preschool or something the year before kindergarten that was socialised, that helps getting one or both of the parents back to work sooner. And
Yeah.
I think there's
In Tassie-
developmental things that are good. I don't know.
Tassie, they start school at 4.
I started at 4.
And that's where,
That's why I'm
our daughter
illiterate
started
at everything.
4 to turn 5 in March. But like this is like the year before everywhere else. You're kind of starting, and it's a transition in. I think they do 3 days a week or something like this. Every state's so different. Well, because our clients are all over the place, so we have to learn this as we're running around, going
Yeah.
where. Oh,
But
moving in and out.
we've seen the recent proposal to change the childcare subsidy so that households with $500,000 household income can get subsidised daycare with no work test.
A little bit, but yeah.
I mean, this is probably going to, Mossman housewife tennis mornings that the average battler is subsidising. That's hardly good public policy.
Yeah, it's funny. Like, yeah, I agree. But I always struggle, like, when I, with all my medical crap and, I go get an MRI, for example, and I walk out and I pay the $300 or $600 for the MRI or whatever. And I'm like, this is actually odd because why am I paying $600 for an MRI? Or it's the other way around. I think the other way, it was a CT scan or something. Why was that bulk billed? Why is this bulk billed? I can actually afford to pay this. I pay $500 tomorrow for a CT scan or whatever. Don't notice it in my life. But then you think, well, I pay more tax than someone who might not be able to afford it. And I think that's the dance, isn't it?
That is the challenge. You go,
And are you like, $500K, fair chunk of tax gets paid.
Sure.
But yes, they could probably afford not to have that concession.
Yeah, I mean, so it's a question of when you're saying this should be paid for by society as a whole, and therefore, I guess, indirectly saying that 20% or 40% of it's going to be paid by the top 5% of taxpayers, or whatever the maths is these days. Is that the right choice? So we've all concluded that primary and secondary education is effectively a
Socialised.
human right. Everyone gets it for free. And
Much like fire department.
yeah. But what about university? So should non-graduates subsidise higher earning graduates? That doesn't sound very sensible. So, but we've decided that we will subsidise it. So the student contribution through HEX is about a third of the real cost of your education.
If there's one thing that society pays for that you think should be private, what do you reckon that is?
I must admit, I think a lot of this parental stuff has possibly gone a little too far. But that's a value judgment, and that's a judgment that we need to make as a society. There are some things that can't be privatised. Yeah, defence.
Yes.
What about roads? Yeah, should users pay for roads?
Yeah.
But we do in New South Wales.
I mean, New South Wales, honestly, the New South Wales government, what they've let happen to Sydney with the tolls, it's outrageous. Now, I can see both sides of the coin, but I mean, I don't know, it's outrage. And, Transurban, they've got all these tollways. They've got a baked-in CPI increase every year for the contract, regardless of what happens.
But
And
the bit they don't tell you about that, though,
Mm.
is that when those contracts were let, the government charged what's called a concession fee, where these companies, where effectively the bid was not how good your road is, but how big a concession fee you're prepared to pay the government.
Yeah, and
So the
and
government
Vince knows
received-
infrastructure because he used to probably broker these deals at Macquarie Bank. But it's just outrageous because
It is.
You travel the M2, right? Paying this. It's the worst road in Sydney.
Well, there's $26.40 in tolls from my house to here.
Yeah, it's the same for us. We want to go to Sydney and back. It's nearly $30.
But
That's
that's-
one way. 26.
Yeah,
I don't
so
know
the
how much of it's
question
paid both
is-
ways.
It's obviously at the time for that government, it's easier to privatize it to get it built than have to borrow the money and make your budget look bad.
Yeah. But there was also a huge check written by the road operator to the state government.
So answer this for me, Mr. Infrastructure. Within the last 5 years, the Sydney Harbour Bridge toll that was ending because it was only supposed to be on for like 50 years, it ended. Supposed to be free. Guess what's back on the Harbour Bridge now?
Well, the M4 is the same. So the M4 concession expired, and the toll actually did come off, I think, for
10 minutes?
well, maybe it was months, but it wasn't for very long. And they put it back on to pay for which of the extensions? One of the extensions.
Yeah. But infrastructure, it's just a wild time. So, and the crazy thing
And
is,
that's why at Sherpa Invest we put a significant chunk of our portfolios into infrastructure.
well, good income generating asset. I mean, they're not going anywhere. They've got contracts with the government. Just don't buy the Cross City Tunnel in 08 if you're MTAA Super. Was that the ones?
MTAA,
They got
which
spanked.
is now Spirit Super, but they were a very early investor in infrastructure.
But they got spanked
And
on
they
the
did
Cross City
real-
Tunnel.
Was that-
That was where it got revalued because no one used it. Remember, we built the Cross City Tunnel in Sydney. You can walk
was
through
a-
there
it
at
was
9
a-
a.m.
yeah.
either direction.
It was a
and
ghost town.
and
I remember
no
that.
one's in there.
And you know why?
Why?
Well,
I think I do like they put the entry and exit in the wrong place.
Well, the fundamental justification for the Cross City Tunnel was that you should take the east-west traffic out of the city so they could reprioritise the north-south traffic lights in the city.
right.
That was the original justification for it.
Oh, to make the north-south flow. Expensive flow.
Well, and the original deal was the tunnel was only supposed to go as far as the museum.
But it went over to
Because
William Street.
they got a
past.
non-complying bid with a bigger check for the government with traffic that could never be justified. So I actually worked on one of the losing bids for that. So I actually happened to know the numbers.
Gosh.
And it just made zero sense. It was never going to work.
What do you reckon that should be privatised or not subsidised?
So I just think councils need to stop charging for beach parking. That is an absolute killer.
Don't you get a residence permit like we do?
No, there's not. Look, we're okay in Newcastle, but the
It's
way
un-Australian, isn't
Sydney runs their beach car parks, it's a council gold mine, just cashing in on, and it's like I'm in Manly's.
It's just
Well,
small.
Northern
It's
Beach-
just, it's just real
But
estate.
Northern
hour
Beach's
to park.
ratepayers get free beach parking. That's a statement.
They've
of
got
fact.
they get one a year per their rate for their rates
I think
notices.
let's get two.
I think is it 2 now? Yeah.
Um,
So
In Mossman Council, you pay a small amount for it.
but it's only in your area too. And so when you live in
Well, the Northern Beaches is most of the decent beaches in Sydney.
but if you live in Manly, it's
Controversial statement.
vice versa.
What's wrong with botany?
Maroubra, Malabar.
Yeah, I don't know. What would I do or not do? I don't know. I reckon. No, I don't know. I don't know. It'd be something to do with. I don't know.
What a $2.50 public transport for oldies.
Yeah, I don't mind that. I'm all in favour of legitimately helping people
That actually
who
need it.
actually need it. I mean, yeah.
It's just the government isn't always in the same.
Anyway, we're going to leave it there. So, in finishing, Jimbo, what are you doing tonight for V-Day with Tash?
We've done our V-Day today. We went for a romantic walk this morning with our puppy, and nearly 16 years of marriage. Yeah, we're still in honeymoon phase.
Good to go. What are you doing, Vince?
I'll be driving back from
You going
Newcastle.
to see your lovely Kate?
It'll be too late by the time I get back to Sydney.
Yeah, well, it's 5:30. You'll be home by 7:30. I'm probably watching something alone on TV over a pizza.
That sounds amazing.
Anyway, we'll end this. Thanks for listening, everyone. Vince Scully from Life Sherpa. Thanks for talking about Life Sherpa Invest. Jimbo from Sufficient Funds. Thanks for coming down. We'll do it again soon.
Thank you.
Thanks for having me.
And
Great road trip.
Be good. Bye.
Bye.
Bye for now.